we're seeing AI jitters coming back into the market.
The risk atmosphere is elevated.
If I broke tech down, the dispersion between the haves and the have-nots are almost unbelievable.
People should not be so concerned about the absolute increase in overall market capitalization. The concern should be the concentration.
Earnings growth is the last engine of return. And look, it's still on. That engine's still going.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, bouncing back, precious metals rallying, equities heading back towards all-time highs as SpaceX and XAI are combining with a $1.25 trillion valuation. And the BLS is cancelling payrolls Friday as the gridlock in Washington keeps the government shut down.
You're trying to trigger me. I mean, honestly, we're all Bill Murray, just living in Groundhog's Day. Every other week, it feels like we get this government shutdown, and now it's delaying the gold standard when it comes to labor market data that would have come out on Friday. It delays the JOLTS data that we should be getting at 10 a.m. today. It gives us a sort of more noise that we have to grapple with. And ultimately, the good news is we'll probably get some sort of resolution at least today. The bad news is in 10 days, we probably are going to have to do this all over again with that much more aggression before some sort of leave that people are going to be taking because they always go on vacation.
So you're super excited to cover the story just like me. It's the quote none of us wanted to read from the BLS yesterday. Due to the partial federal government shutdown, the Bureau of Labor Statistics will suspend data collection, processing and dissemination.
So the problem is, this is the week that they would release it on Friday. And on Wednesday, the commissioner, that's tomorrow, would get the report from the individuals that are tasked with working on the BLS report. Well, they're not at work today, and they weren't at work yesterday. So the commissioner can't get the report. The commissioner then can't go to the White House, which would be on Thursday, give the CEA the report, tell them, tell the president what's going on, and then Friday release it. That's the plumbing behind the BLS that now we all know too much about because we continuously see this government shutdown. Trump was able to strike a deal with these holdouts yesterday, so all of the funding will go through, except for Lisa says DHS, and that's going to be another fight.
So do you want some good news? Manufacturing data was pretty good. India and the United States taking down the temperature just a little bit. Then go to corporate America. Palantir earnings solid. Decent debt sale from Oracle yesterday as well. $25 billion worth, and that was taken down pretty well.
This is a reason why you saw record highs. This is a reason why you broke the snap in some of the gains, in some of the losses that we had seen over the past week. There's a real question here. How long can markets continue to ignore the increasingly mounting noise that we get from Washington, D.C., from geopolitics, from all sorts of other headlines that change from day to day, while the earnings kind of march in a steady beat? And that ultimately is what a lot of investors are trying to focus on.
Just take the story to outer space. Get away from planet Earth. This quote, the most futuristic statement I've ever heard from SpaceX. From the most ambitious vertically integrated innovation engine on and off Earth with AI rockets, space-based internet, direct-to-mobile device communications, and the world's foremost real-time information and free speech platform.
You're, of course, talking about the $1.25 trillion tie-up between SpaceX and XAI, with Elon Musk saying that the reasoning behind this is because ultimately it's going to be cheaper to do the computing in space than here on Earth, kind of combining his efforts and focusing far, far away from the car industry.
Also, the fact that they have this electricity demand and energy demand, he says basically you could do that with outer space solutions, and it's even better for the environment down here on Earth. So he's looking to outer space to expand the AI data centers and everything else that AI trade needs.
We've got a lot to cover this morning. Coming up, we'll catch up with Julian Emmanuel of Evercore with stocks on the brink of all-time highs. Angelo Zeno of CFRA on the rift between OpenAI and NVIDIA. And Steve Englander of Standard Chartered as the government shutdown delays the payrolls report. We begin this hour with stocks bouncing back as big tech regains some momentum. Julian Emmanuel of Evercore writing, macro disturbances are creating more stock market volatility, but a capital market cycle only beginning to accelerate means the bull market has further to run. Julian joins us now for more. Julian, good morning.
Good morning.
You published just moments ago. You called it Groundhog Day, all noise, no signal. Is that the last 24 hours or the last month?
I think it goes back to January 20th of last year, doesn't it, really? It is an environment where we are in a state of unprecedented flux and change, geopolitical makeovers. But the abiding concept, when you look as an equity investor, is that earnings are really going strong. Fourth quarter is set to look at maybe 14% earnings growth, really extraordinary. And it sets the table for a very good 2026.
It's a very, very volatile backdrop at the moment, though. Take South Korea. South Korea down 5% Monday, up 6-7% on Tuesday. What does copper, gold, and South Korean equities have in common right now?
It's the momentum concept. It's the speculation concept. What's interesting is the bifurcation in the technology sector. So Korea is doing what it's doing because you've got two heavyweight stocks that are chip makers that are, really have been powered forward. Whereas software, on the other hand, is in the doghouse like, nobody's business at all. And at the end of the day, the sum total in our mind is that people are cautious with regard to technology. And think about that. That's actually the kind of wall of worry that keeps markets moving forward.
Can you have a market that moves forward without the leadership of big tech, without momentum returning to some of these big tech names that still are below some of their all-time highs that we saw late last year?
In our mind, it would be very difficult. It's a problem of mathematics, whether it's the top 10 at north of 40% in the S&P 500 or the three tech-focused, AI-focused sectors accounting for 55% of the weight of the index. You need them. Fortunately, in our mind, if you look at the NASDAQ 100, you've basically been going sideways since October. And in the past, over the course of this bull market, you've had those times where you've just gone sideways and the resolution of the price pattern is higher. And we think earnings are going to drive that once again.
Have the earnings momentum really shifted to the other 493? And I hate using this because it's really a myriad group of different stocks. And some of them, Pepsi just reporting earnings and saying that they're planning to cut prices. And part of this is because of AI efficiency gains. I mean, how much are you starting to see that trickle out in what people were hoping for, at least last year?
Well, it is part of the narrative that, again, in our mind, by the time that this year is over, is going to sort of tear down that wall of worry around AI and around the potential for productivity to be on a secular uptrend because of the benefits of AI. And at this point, when you see these anecdotes, what it does is that it puts pressure on the competition to show how they are driving revenues and cutting costs using AI. And in our mind, when you look at it on a stock-by-stock basis, sector-by-sector basis, if you can't show a coherent strategy as to how you're capitalizing on AI, by the end of this year, you are going to be judged to be at a competitive disadvantage. And you're already seeing that differentiation in the market.
When it comes to what's going on in gold, does it give you pause, or is it uncomfortable that gold is basically trading like a meme stock?
Well, so there is precedent for it. And interestingly enough, silver actually during the meme stock phase in early 2021 had a volume spike that was similar to the volume spike we saw in the SLV last week. That essentially the same thing. Prices ramped and then it fell back. Look, the thing about the precious metals is it's been a source of angst for over a year. A year ago, it was like, okay, precious metals are rising and the S&P is rising. There's got to be a systemic issue. And then it was gold and silver going parabolic. There's got to be a systemic issue. And now it's gold and silver, and I think the word is appropriate. Silver crashed in the last week. That is a crash. And there's got to be something systemic. No, there doesn't have to be something systemic, because like the meme stocks in 2021, those areas as a percentage of market cap are not big enough to disturb the S&P 500 or the global stock market.
Begs the question, what is? Because we've had these explosions across different asset classes now, in JGBs, in precious metals. What is big enough to disrupt this equity market?
In our mind, the one thing we continue to focus on is the 10-year yield in the U.S. Okay, we know at the short end that there's going to be what we would call cooperation in the guise of, perhaps 2, maybe even 3 interest rate cuts this year. But the long end at some point is probably going to become pressurized, and that will be the test for equity markets.
What do you mean by cooperation?
Rate cuts. Rate cuts in an economy
in
that's growing.
In cooperation with who?
when the worst Fed starts, I would expect that there are going to be rate cuts.
When you say things like that, it makes me wonder what's going to happen to the gold trade by the time we get to year end. It makes me wonder what's going to happen with the dollar trade. There was a thought, I think, on a lot of desks over the last few days, and this is from Morgan Stanley, that the Kevin Warsh nomination had a stabilization effect on some of those trades. Diplomatically speaking, it upset them. Now, I'm wondering how you're thinking about that into year end.
So when we look at the metals, think about the range of the last week and a half, absolutely breathtaking. Essentially 55.50 on the high in gold and, 4,000 and change on the low. It would not surprise us at all if we had a digestive phase, and that happens typically after a crash of that kind of magnitude, that both bulls and bears get frustrated. And frankly, in this kind of environment, you want to see volatility come in other asset classes. And if you look at it, the fact that Treasury market volatility has been as well behaved as it has been a huge tailwind for the equity market.
$500 range on gold in the last 24 hours alone.
Okay, I know where you're trying to lead him to. Is the Fed's independence being jeopardized?
He was taking us there. What do you mean lead? He was pulling me in that direction.
Absolutely, just reeling you in.
Cooperation.
Look, this to me is interesting because if you did believe this, you would price in more rate cuts into the market. And right now, actually, you've seen the number of rate cuts priced into the market go down after yesterday's ISM manufacturing report. So right now, the market might not be drawn to the same watering hole as Julian Emmanuel.
The RBA also reminding us that central banks can hike as well, and we'll talk about that story a little bit later. Julian, you're going to stick with us. Julian Emmanuel of Evercore. Equity futures just about positive by 0.1% on the S&P, with an update on stories worldwide this morning. With your Bloomberg brief, here's Vonnie Quinn. Hey, Vonnie.
Hey, John, good morning. President Donald Trump is pushing House Republicans to accept a deal he struck with Democrats to end the partial government shutdown. In a post on Truth Social, Trump telling lawmakers to swiftly pass the measure with no changes. The bill would fund most agencies through September and the Department of Homeland Security through February 13th. PepsiCo shares falling in the pre-market after reporting fourth quarter earnings that topped expectations. The company announcing plans to buy back up to $10 billion worth of shares through 2030. The Wall Street Journal reporting the beverage and snack company is looking to cut prices by as much as 15% on products. Elon Musk is combining SpaceX and XAI at a $1.25 trillion valuation. Musk says the company will work on AI, rockets, space-based internet, and other technologies. Sources telling us here at Bloomberg the company is still planning an IPO later this year. The offering could raise as much as $50 billion in what would be the biggest initial share sale to date. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie Quinn later this hour. Up next on the program, gridlock in Washington.
I spoke with Speaker Johnson, I spoke with Leader Thune, and I think they're pretty close to a resolution. I spoke with Senator Schumer numerous times, and I don't think they want to see a shutdown in it.
Team coverage up next with Bloomberg's Tyler Kendall and Mike McKee from New York City this morning. Good morning. Equity futures on the S&P positive by 0.1% on the S&P 500. On the Nasdaq up by 0.4. This from Pepsi this morning, out with earnings moments ago, but it's this story from the Journal that is going to get a ton of attention. PepsiCo is looking to cut prices by as much as 15% on its products. This direct from the Journal. The beverage and snack company is making the cuts after receiving a flood of emails and voicemail messages from shoppers complaining that high prices were making it hard to buy the company's snacks.
So it's a price cut of about 10 to 15% across a number of different products. For example, Lay's Classics potato chips would fall in price to $4.29 from $4.99. And the idea here is that if there is a certain price point, people will be more willing to just put it in their basket and not necessarily get worried about the price that it adds to it. It highlights, though, where is that money coming from? some of the cost cuts that they've made pretty much across the board. And some of this comes from new technologies, including artificial intelligence. They are reinvesting it back in price. I find this fascinating. Is this the beginning of the same in some of the companies that are in a similar industry?
Look, it's one data point, but it's one important data point, and that's the kind of data that you don't hike rates in. That's the kind of data you cut rates in.
This is the elixir of productivity that people are talking about, that you can increase efficiency and then lower prices. This is disinflationary. And this is the reason why the likes of Fed Chair Jay Powell are saying this isn't necessarily a super inflationary environment. That said, this is one company, as you said. How much do we see this across the board, especially with the prices of the materials popping, which really feeds into the Australian issue of why they're hiking rates? Because guess what? They're on the other end of those price increases for some of the commodities. So it's a really difficult story.
So which side of the debate are you on right now? Andrew Honhorst of Citi still looking for 75 basis points of rate cuts for the year ahead. Andrew was looking ahead to the payrolls data on Friday. He's not going to get it. Under surveillance this morning, gridlock in Washington.
I spoke with Speaker Johnson, I spoke with Leader Thune, and I think they're pretty close to a resolution. You know, we were at 5.6% GDP, and we lost 1.5 points because of the 42-day shutdown. Think of that. We would have been at 7. Nobody ever saw a number like 7. It's very bad for our country. But despite that, we have the highest numbers we've ever had. I spoke with Senator Schumer numerous times, and I don't think they want to see a shutdown either.
So here's the latest this morning. The president urging holdouts in the House to strike a deal to end the shutdown. The shutdown's impacts beginning to build, with Friday's payrolls report now delayed. Our team coverage starts right now with Bloomberg's Tyler Kendall in Washington, Mike McKee in New York City. Tyler, first of all to you, are we close to a breakthrough?
Looking likely. House Republicans have teed up a vote for today on the $1.2 trillion package that would end the partial government shutdown. As you mentioned, President Trump made it pretty clear yesterday in a post that he wants House Republicans to get on board with this compromise that was struck between the White House and Senate Democrats as it stands. In fact, 2 holdouts had confirmed that they had direct calls with the White House yesterday, and in exchange for that call, they are dropping their demands to tack on some separate legislation related to tightening voter restrictions during elections in exchange for their vote on government funding. Now, while it is looking likely, we should say it's not quite a done deal yet. House Speaker Mike Johnson is probably going to need some moderate Democrats to get on board to get this bill over the finish line. But the package as it stands would fund most agencies through September 30th, but then separates out that Department of Homeland Security funding and only funds it through February 13th, which is setting up the real, more precarious issue at hand, which is that lawmakers are only going to have 10 days to reach a compromise on full fiscal year funding for DHS and also new curbs on immigration and customs enforcement. And that is proving a lot more difficult than it sounds already, as some Republicans are balking at top demands from Democrats, including new warrant requirements and also an end to federal agents wearing masks. John, I will say we saw some bipartisan agreement yesterday. Democrats applauding the DHS Secretary Kristi Noem announcing that federal agents on the ground in Minneapolis will all wear body cameras. But at this point, Democrats are saying that is not going to be enough. They need to see some of these changes codified into law.
So, Mike McKee, let's talk about the disruption to the economic data. Go through the data for this week. What aren't we getting? What are we getting?
Well, we're getting a lot of private sector information, John. Like tomorrow, we'll get the ISM Services Index. We got the ISM Manufacturing yesterday. What we won't get are the JOLTS report today, which is not a terrible loss in terms of trying to figure out where the economy is, but it is a clue. And we don't get the payrolls report on Friday. But if you had to have a shutdown, this is probably about the best time to have those kind of numbers delayed. Fed doesn't meet again until March 18th, and so there's no immediate pressure on policymakers to decide whether there's anything wrong with the economy and they have to take action. We are expecting a slightly better jobs report than we had in December. So that even keeps some of the pressure off here. You could move it to next week. Now, if the vote fails and we keep the shutdown going, next week we lose CPI and we lose import-export prices. And so you would lose both ends of the Fed's mandate, but there's still time to get those back.
Mike McKee with the latest on the ground alongside Tyler Kendall. Mike, Tyler, thank you. Julian Emanuel of Evercore still with us around the table. Julian, how many people build a successful equity portfolio based on payrolls in the last 12 months? As we all sit here and say, I miss payrolls, I want to see payrolls, I'm right there with you. But how instructive has the payrolls report been for an equity strategist?
I think maybe destructive instead of constructive. It's just, look, the conundrum of the morphing policy on immigration versus what the break-even monthly payroll number is versus the fact that the weekly jobless claims are incredibly subdued at this very low level causes a sense of confusion in general. And we were asked yesterday whether we thought it was a big deal that the payrolls number was going to be delayed. And frankly, it's just another piece of noise right now. And actually, in a way, and I agree with what Mike McKee just said, this is probably a good time to not have this report for the next couple of weeks, particularly since at some point we're going to have to evaluate whether the weather of the last several weeks has any effect, transitory or not, and probably transitory. But, you know, it reminds us of the first quarter of 2014, where you had the introduction of that phrase, polar vortex, and the economy actually contracted and then had a couple of 5+% GDP quarters in a row. And again, you're looking at that same type of growth.
Some of my favorite topics, government shutdown and weather-disrupted jobs reports. I mean, this is really exciting. I've got to say, you do have to wonder at what point, though, it does start to matter. And that's where sentiment surveys come into the fore. And that's where things like Pepsi's 10 to 15% price cut comes into fore. Why are people demanding these price cuts if they didn't feel somewhat not great about the economy, about their labor market prospects? And that will eventually, should have some kind of effect, no?
Well, if you look at it again, one of the remarkable things about this entire bull market cycle is how bad consumer sentiment measurements have been the entire time. And it's really driven by this affordability issue. It's real. There's no, masking it. And frankly, I was shopping this past weekend, and it was shocking, some of the prices. Absolutely shocking. You're not necessarily anchoring anymore to what the pre-pandemic number was. But, when you see things that you talked about, a bag of potato chips that was 3-something at 4-something, that's the kind of thing that really grates on psyche. And that's why consumer sentiment remains as depressed as it is, even though the spending is strong.
I'm dating myself, but it was 99 cents on my way home from school when I got it for a snack. Just saying. I am curious, though, at what point this starts to eat into the strong economy narrative. We were speaking yesterday with Matt Miskin of John Hancock, and he was saying, look, I reject this idea that we're heading towards some sort of reacceleration, and I also reject the idea that we're heading into some sort of downturn. This is sort of the pre-pandemic norm, and we're going to kind of slow down and get to a new place, a new normal that's lower. Do you agree with that, or do you think that this sort of productivity elixir is going to create this sort of hot, but strong but not hot kind of growth?
The kind of numbers that we're seeing right now are not likely sustainable. I mean, we're calling for 2.5% GDP growth in 2026. But to your question, it all comes back to the one thing it always comes back to: jobs. Okay, if the job market is strong and people's income, and they feel, regardless of how they feel about what grocery prices are, if you have a job, the economy moves forward. And more importantly, if you have a job as a retail investor, you do not have to sell your stocks.
Julian, it's good to see you. It always is. Thank you, sir. Julian Emmanuel of Evercore on the many contradictions coming into 2026. Let's take the earnings from MasterCard or a Visa in the last 12 months. Those numbers have been great. Then you look at consumer confidence, rock bottom at the conference board. Which data point are you going to trade on? Because one has been a decent indicator of things and the other has been not so helpful.
Look, it's a cliche, but it's the K-shaped economy. If you look at averages, the average spending looks good. If you look at the actual granular medians, not so much, because on the lower end, people are not spending. It all comes down to jobs, but the jobs report hasn't mattered. So it just is a conundrum wrapped in an enigma, wrapped in a riddle.
But for the White House, this is really challenging. To Julian's point, it's about jobs. In those consumer sentiment, you actually see people not just anymore talking about higher prices. They're worried about going out and finding new jobs.
I saw Julian smiling then. It's about jobs, but it's not about jobs.
I mean, that's essentially what we're talking about.
But it's about jobs.
I mean, it's sort of, ignore it. It's absolute noise, weather, but it's really important.
What do they say? When your neighbor loses their job, it's a recession. You lose your own, it's a depression.
Yeah, well.
Something like that, right?
Especially at these prices.
Coming up on the program, we'll catch up with Angelo Zeno of CFRA on reports OpenAI is looking beyond NVIDIA to supply its chips. Plus, Yahara has your morning movers. Check out Palantir this morning. The stock is up by 11% from New York City. You're watching Bloomberg TV. Snapped a three-day slide on the S&P 500 in yesterday's session, this far away from all-time highs. Futures up by another 1/10% on the S&P, on the Nasdaq up by 0.4. In the bond market, ISM Manufacturing, solid print yesterday. Details and some of the industry feedback a little bit murky, and we can talk about that later, but we traded off that headline print, and that headline print was hot. Yields are up in the last 24 hours, up another single basis point on 10s to 428.95. And this move in gold, an update on precious metals for you. Gold in early trading higher by 5% after a really volatile 24 hours. SocGen fantastic just yesterday. Gold prices didn't correct, they deleveraged. The extreme moves speak to positioning and not fundamentals. Central bank buying was not driving this leg of the explosive rally we've seen over the last 12 months. It was being driven by ETF flows. Priced a heavy political risk and debasement premium. This is what SocGen say. The Walsh appointment signaled low institutional chaos that undid some of these moves.
Well, this is a reason why people saw that huge swoon, not just in gold, but also in silver. People attributed it to the Kevin Warsh effect. Essentially, Fed independence wasn't going to be challenged as much. Suddenly, there doesn't need to be this rush into havens outside of the dollar. The fact that it's up more than 5% this morning, the why behind it, yes, it's technical. You can't give any other reason. You can't give a sense of now people are worried about it again, or now gold miners are, reducing supply, or now Chinese investors are coming back in. This is entirely a technical move, and this is going to be the increased level of volatility that many people are expecting in this space.
Can it stay in this space, or does it bleed out into other asset classes? Gold up by 5%, silver up by about 8%. As we count you down to the opening, about 3 hours away, let's get you some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We start with Palantir. Shares are soaring 11% in the pre-market after a big top-line beat and strong guidance fueled by soaring demand for Palantir's AI tools by both business and the U.S. government, of course. But this stock move we're seeing is a sharp reversal from a recent trend. Shares had been down 30% since a recent high a few months ago. A lot of that having to do with valuation, a top concern, an ongoing concern for this company, as it's one of the most expensive on the S&P 500. Meanwhile, moving on to AES, those shares up 6% on our scoop that BlackRock Global Infrastructure Partners and EQT are teaming up for a potential takeover. This is a power company based in Arlington, Virginia, and it supplies renewable energy to the likes of Microsoft. These power names have drawn strong investor interest due to their role in the AI build-out as demand for electricity continues to soar. And we end on SanDisk, continuing its hot streak, up nearly 3% in the pre-market after being up nearly 16% yesterday. The stock has now been up for 5 straight sessions and is up nearly 180% just this year. All of this having to do with soaring demand for its memory chips. It says demand is far outstripping supply, and that is giving them major pricing power. John.
Yahira, thank you. More from Yahira in the next hour. On our radar this morning, Elon Musk consolidating his empire, combining SpaceX and XAI. The deal giving the new entity a valuation of more than $1 trillion. The company aiming for an IPO expected later this year. Elsewhere, Samsung Electronics shares soaring, recording their biggest one-day jump since 2008. The benchmark Kospi extending gains as a recent rush to secure memory chips for AI powers the record run in South Korean equities. And finally, we're all tracking this spat. OpenAI reportedly frustrated with NVIDIA's chip performance. Reuters reporting that ChatGPT maker is discussing working with rival chip producers. OpenAI CEO Sam Altman praising NVIDIA, saying, quote, they make the best AI chips in the world.
Oh, I love how catty this space is getting. I mean, ultimately, there's a question about whether NVIDIA is challenging some of the legitimacy or the efficiency of processes coming from OpenAI. OpenAI, of course, may be raising questions about who they're going to partner with. The idea, though, that these two are interchangeable, that they basically are intertwined, not interchangeable, but intertwined, just highlights how this ecosystem really relies on each other. And it's very hard to extricate yourself from one or the other.
It was circular financing, and now the drama seems very circular as well. Jensen Huang questioning Sam Altman coming out questioning, at least according to Reuters, the chips that NVIDIA is selling it. This is what Reuters had to say. OpenAI is not satisfied with some of its latest AI chips and is seeking alternatives. That is almost a shot across the bow for Jensen Huang, who says we have the best in the world.
It's Wall Street Journal reporting versus Reuters reporting right now on this issue. Behind the scenes, they seem to be being pretty blunt about what they think about each other. It feels like OpenAI is kind of being catty and snapping back because the Journal story was scathing. Basically, Jensen Huang is questioning the business approach of OpenAI right now and the way they're deploying capital.
And whether it's irresponsible and whether they really want to be behind it. And to come out and say that it was an invitation to invest $100 billion, and they're not sure whether they're going to really go with that $100 billion figure. It was just a suggestion. It wasn't necessarily a commitment. Highlights they could be pulling back real dollars. If OpenAI IPOs this year, how much does this become a sticking point for both their valuations and, frankly, for the whole industry?
Let's stick with technology stocks. AMD rising ahead of earnings on reports OpenAI is casting a wider net for chips. Angelo Zeno covers NVIDIA and AMD for CFRA, rating both stocks a strong buy. Angelo joins us now for more. Angelo, please weigh in on this spat. What's behind it? What's driving it? And where do you think the chips will fall?
Yeah, so John, I think this makes for great drama to kind of what you guys alluded to. But when we start thinking about this, I mean, listen, NVIDIA continues to have the best ecosystem out there, whether it be the hardware they produce or whether it be their software ecosystem. When you kind of think about where Jensen sits here right now and what he sees, I mean, essentially, you've got OpenAI making commitments with everybody here over the last 6 to 9 months. And in reality, it doesn't matter necessarily to NVIDIA who wins this game at the customer level, but they want to be involved, I think, across the board. And I think the fact that they're going to be part of this funding round for OpenAI tells you that, but it also says something in the sense that, hey, listen, we're not going to kind of, dish out everything that, from an investment perspective, just given the fact that, hey, listen, maybe OpenAI isn't going to be, the natural winner out there. Maybe it's somebody else. So, the fact that you've seen investments from NVIDIA and the likes of Anthropic and others of the world, I think is really telling as well.
Is there a larger message here, Angelo, if you just take a step back and you start to look at the fact that big tech hasn't reprised some of the record highs that we saw last October, that you see a lot of skepticism around some of these funding rounds or additional investments in OpenAI on behalf of the likes of Oracle? I mean, is there a tell here in terms of where we are in the cycle and how behavior has to be reined in going forward after a couple years of pretty profligate spending?
I think there is. I mean, I think when you kind of look at 26 right now, 2026, it's really a year of execution. It's a year where I think investors are, in some respect, trying to de-risk some of the uncertainties that are out there. Less so about what's going to happen here in 2026 and maybe even into 2027. There's some great earnings power across the tech sector. But when you start thinking about, I'd say, the out-year estimates, right, the tail risk for a lot of these tech-related companies, across the AI ecosystem, there's some real concern out there, right? Whether it be the cloud providers like a Microsoft, whether it be the other software SaaS-oriented companies, or even at some point, I know semis have been the heart of the trade here over the last 3 years, but probably going to see some, concerns about the sustainability of semi spending at some point in time. So you're seeing those multiples really compress here over the last couple of months, and that's really weighed on the tech trade. I don't know if that necessarily changes or not. I think you'll see points of better sentiment as the year progresses, maybe as OpenAI gets some of the funding that they're looking for. But nonetheless, I mean, I do think this is a year where multiples really are coming in a little bit to account for some of those risks as we look ahead.
At the same time, Angelo, how much do you see the spigots of financing completely open after yesterday's $25 billion Oracle sale that I believe had something like $129 billion worth of bids, and it came in much oversubscribed with yields coming in significantly? I mean, how much is this sort of the all clear sign in terms of the ongoing funding pipes?
Yeah, I'd say for some of the bigger companies out there, there's still high demand in terms of kind of the demand for liquidity in terms of receiving the capital for these companies. I wouldn't necessarily say it's all clear for any company out there looking for funding, but yeah, I mean, right now it's an attractive environment in terms of companies looking to get that funding. I think there might be to some extent a rush to get some of that funding locked up here. I think it was a very smart move for Oracle to kind of look at that here early into 2026 and look at that 50 billion or so. But it'll be interesting to kind of see how things progress here over the next couple of years or so. But right now, I mean, it's absolutely a healthy environment.
Well, do you think they're over-leveraged, that wall? Because they say that developing these data centers means they're going to be negative free cash flow at least until 2030.
I mean, for Oracle, we stay away from the name. I mean, it's a name that we did downgrade a couple of months ago, and in our view, it is a name that just carries way too much risk. I mean, you alluded to the fact that, hey, listen, they're going to be negative free cash flow here over the next couple of years. They're raising more debt. They may need to potentially tap the markets again at some point in the future. It won't be 2026, but maybe 27 or thereafter. Again, we have to wait and see what the trajectory of that build is going to be. But when you start looking at the risk reward opportunities out there, you can really kind of benefit and see some of the upside potential from these AI trade just from better capitalized names. Whereas if we were to see a hiccup in terms of the AI trade, let's say we see supply demand come in balance here over the next couple of quarters or years, companies like the NeoClouds and the Oracles of the world are probably going to get hit a lot harder than a company like a Microsoft or an Alphabet or an Amazon, which is obviously better financially positioned.
Angelo, it's good to see you. It always is. Thank you, sir. Angelo Zeno there of CFRA. I'm pleased you brought up that question because I think it's the ultimate question right now. How speculative is the capex build over at Oracle? Now, if you go through the Fitch note yesterday, they assigned a BBB rating to the debt that was issued in the last 24 hours. And there's this quote that sits in their statement. Fitch believes that Oracle's risk exposure is manageable in the near term because its capex is tied to typical multi-year revenue contracts with major AI customers that have strong financial backings, including a range of companies, but this is one of the companies they name, OpenAI. If that multi-year contract is tied to OpenAI, just how speculative is that build?
Especially if some of the financing letters of intent are not commitments, but simply invitations to finance the company. I mean, it starts to be dependent on OpenAI, which is dependent on NVIDIA and Microsoft and Amazon. So it raises this issue of, is there some sort of blind spot? And yesterday we did not see it. And I think that that's notable, that still bond investors are clamoring to buy this debt, seeing it as high quality. Will that change? It isn't changing yet.
Sitting right on top of that line between junk and investment grade, just right there at BBB.
Yeah, and will it get downgraded right now? Again, the fact that you saw spreads on those bonds come in so significantly during this bidding process highlights people are kind of shrugging some of that off right now.
A better 24 hours for that name, that company, for Oracle. Let's give you an update on stories worldwide this morning with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. President Donald Trump and India's Prime Minister Narendra Modi agreeing on a trade deal. U.S. levies on Indian goods are being cut from 25% to 18%, and that 25% punitive duty tied to purchases of Russian oil, well, that's being scrapped. President Trump writing on Truth Social, India agreed to buy $500 billion of U.S. goods and halt crude purchases from Russia as part of the deal. Australia is the first major economy to hike rates in 2026. In a unanimous decision, the RBA raising its key interest rate after determining inflation pressures were persistent enough to warrant renewed restraint. Governor Michelle Bullock avoiding any hints that further tightening is possible, though, saying, quote, "It's not clear one way or the other." Merck shares are falling in pre-market trading. The pharma giant missing its 2026 forecast as Chinese demand for its HPV vaccine continues to drop. The drug maker is also facing new challenges in the United States, where health officials are now recommending fewer doses of the vaccine. And that is your Bloomberg Brief. John.
Hey, Vonnie. Thanks for the update. More from Vonnie in the next hour. Up next on the programme, data delays.
Some data is better than no data, and even late data is better than holes in the data. But I think there's still questions in terms of how robust this data is.
Steve Englander of Standard Chartered has plenty of questions. He says it's not the gold standard, it's fool's gold. That conversation up next. Within striking distance of all-time highs, futures positive this morning by about 0.1% on the S&P after snapping a three-day slide in yesterday's session. On the Nasdaq, we're up by 0.4. On the Russell, up by 0.1. Under surveillance this morning, data delays.
some data is better than no data, and even late data is better than holes in the data. So I think it's helpful in that regard. But I think there's still questions in terms of how robust this data is, just given sampling periods shifted, survey response rates potentially obstructed by just the interruption of the normal course of procedure.
So here's the latest this morning. Friday's payrolls report postponed as the government shutdown drags on. Steve Englander of Standard Chartered writing the US data quality has become, quote, more fool's gold than the gold standard. We expect the uncertain quality of the data to become the bigger issue than statistical agencies and the Fed have so far acknowledged. Steve joins us now for more. Steve, good morning.
Hey, good morning.
Tell us what you really think. What's going on here?
Look, it's become so common to say that the U.S. data are the gold standard, and they may be compared to everything else. But there's so many holes in the data that haven't been addressed. And I'd say that, BLS, is not political in the sense that Trump accused them of being, but they've been kind of intellectually lazy over the last decade.
What's making them intellectually lazy? You're suggesting it's not just response rates. What is it?
Well, you look at the birth-death adjustment, which is basically more than half the employment growth we've been getting. And it doesn't reflect anything that's happening in real time. It's basically an autoregressive model that says what's going to happen January of this year is what happened January of last year. Now they're going to try and fix it. As a consequence, there will be not just the usual benchmark revisions, but big revisions from April through January, or April through December, as well as a big down, weak number, we think, in January.
So, Steve, put the data through an Englander filter. What do you look at? What would you point to that says, you know what, I can rely on that. That makes sense. That's where the economy is.
I've used the image of being in Plato's cave. You sort of see a lot of images on the wall, and you try and sort of put them together to make a coherent story. But even the unemployment rate, which everybody lives and dies by, if the labor force is constant, all it takes is 70 or 80 people reporting that they're unemployed more than last month to push it up by 0.1%. Given how much stress we put on that, that's not a big number.
Okay, so I'll take your Plato's cave analogy, and it seems like we've been living there for about 6 years now with the data being called into question and, frankly, a lot of fluctuation since the pandemic. I just raise a question of, what's your sense then, taking a look at all the images on the wall? Do you see a labor market that's stronger than people think or weaker?
I see a labor market that's pretty mediocre. It's not a disaster. There's no sign that it's falling apart quickly. On the other hand, it really is the case that if you don't have a job, it's, good luck and God bless. I mean, it's just not, the odds that you're going to find a job are relatively low. On top of that, the AI thing, the productivity thing, we think could matter in the short term. Although we're very optimistic in the longer term that jobs will be created. I mean, cavemen, the unemployment rate is no higher now than it was in the day of the cavemen.
Okay. We're really going back to caves and hieroglyphics. I'm just curious going forward about what you're watching to understand whether we're heating up and whether there is a degree of undermining the significance of this data on a permanent level as a result of the government shutdowns that makes some of this data optional depending on the week.
I mean, it can't be optional because the BLS is the only organization that has a real sample, that they sit down and they try and sample the entire country. Everybody else has samples of opportunity, who's posting on LinkedIn, whose payroll checks are you processing, and so on and so forth. They could combine all of this. I mean, there's so much more information out there than what the BLS is using, and information that's available in real time. They can do a much better job than they've been doing.
Trump has appointed someone new on Friday. I reported about it. He confirmed it on Truth. This is someone that people call a data nerd. I got messages from Biden-era people and Trump people saying this is a great pick for the BLS. Do you think a new commissioner could come in and maybe take some of this on board?
I think so. But, I mean, the question is whether he breaks out of the BLS mindset. That, all you do is use inside BLS and you tweak this and you tweak that and everything is fine. Look, in NFP, I mean, we don't use ride shares, we don't use gig workers. They're just as much they're not entrepreneurs, they're just as much employees as we are.
When it comes to this report, we're not going to get it. But you have a very downbeat suggestion for how many jobs are created, actually negative.
Yeah, I mean, I think we're the lowest in the street. So, at least as of yesterday. But look, the problem is that we've estimated that the bias in the birth-death adjustment. We estimated 70,000. Powell estimated 60,000. If they come up with a model that really takes current conditions into account and is consistent with other data sources we have that are better but lagged, all the numbers we've had for the last 18 months, just the birth-death stuff will go down by 60 or 70,000.
Steve, you're a foreign exchange guy
at
heart. What are you advocating for at the moment, given everything you've just said over the last 5 minutes?
Well, like I said, the labor market is soft and softer. In fact, what it tells you is that productivity growth, when we get the numbers that are based on the revised data, are likely to be even stronger than what's been reported. We believe the productivity numbers. We're sort of in the Warsh camp where it's sort of, we think that there's something happening in productivity. Productivity normally does not pick up 4 years into the recovery, 5 years into the recovery. And that's usually a signal that's something structural. That's what we saw in the late 90s. It's what we saw in the mid 60s. So we think that's by far the most important thing that's happening in the economy right now. And, arguing about 25 basis points here or there is kind of a waste of time.
What do you think we should be arguing about?
We should be trying to estimate productivity growth better and understand the dynamics that's going to happen. For example, we're dollar bulls because we think the U.S. has the labor market flexibility. You don't need a Bloomberg journalist, you let them go, but you find something.
Sorry,
I didn't mean that. You don't need a foreign exchange economist, you let them go. But you find somebody who's going to, you find some, but you're making money somewhere else. And you look at the profits numbers that we're getting. Historically, U.S. firms hire when they're making money. They might not hire the same people they hired 2 years ago, but they'll say, okay, where are we making money? Let's pick up some people and see if it works. Elsewhere in the world, in France, you buy a truck, you don't like the truck. For business, you sell it in 6 months. You hire a worker, 7 months later, you decide you don't like the worker. He's more fixed capital than the truck.
This has been a secret source of the American economy for a long time. Deep capital markets, bankruptcy, and flexible labor markets. Are we losing any dynamism?
I mean, there's a risk that we are. Look, there's lots of stuff that, Trump is trying to do, or his people are trying to do. I think that's positive for the economy in terms of deregulation. But, the sort of willingness to sort of say, yeah, I see a problem, I'm going to fix it. Like some of the things they've talked about the housing market. To fix the housing market, you have to increase housing supply, not housing demand. You'll just get higher housing prices, but the same number of prices. I think they have to be careful about their willingness to interfere.
That's my concern, too, that we're not embracing the dynamism that traditionally has laid the foundation for the American success story. That if anything, we're questioning it in the last 12, in fact, never mind the last 12 months, the last 5 years. And maybe you can go further back than that.
Well, this is really the heart of the question, especially given the concerns around AI and the pushback that you're getting with people not wanting to lose their jobs. You see this in the likes of, say, UPS, right, where you saw that labor negotiation and some of the workers negotiate for higher wages, and then you saw thousands of cuts as they sort of look toward a leaner new reality. How do you pair both dynamism with a transition phase that's going to be very painful for a lot of families?
Steve, get back in the cave. Brutal. Steve Englander of Standard Chartered. It's good to see you, Steve.
Pleasure.
Thank you, sir.
Thank you.
Tell us what you really think, Steve Englander.
I feel like
about us, about the data.
Okay, I feel like between Steve and Neil Dutta, it's Festivus. It's airing of the grievances. I mean, it's sort of, this is the worst Fed chair. This is the worst data. Intellectually dishonest. Who's next? Come on down.
We've got 11 more months of this to go, Steve.
Look, everybody, look at Europe. It's a joke. I mean, no, but seriously, you got something called Eurostat, but they actually don't collect any statistics.
I wish we had more than 10 seconds left. I wish we did. Steve, it's good to see you. Up next, Victoria Fernandez of Crossmark.
He's going to be coming into a Fed with some challenging things to navigate.
The FOMC, it's bigger than one person, and you can't just get in there and exert your will.
They are not like sheep, they're more like cats. You can't herd them.
Right now, the Fed is in a really tough spot.
We do expect the Fed to remain on the sideline now for an extended period of time.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P, building on yesterday's gains. Futures higher by about 0.1% on the Nasdaq 100, up by 0.4 after snapping a three-day slide on the S&P in Monday's session. This Tuesday, check out Pepsi. And check out this story from the Journal so far this morning. Pepsi lower by 1%. This direct from the Wall Street Journal about an hour ago. Pepsi is looking to cut prices by as much as 15% on its products. The beverage and snack company is making the cuts after receiving a flood of emails and messages from shoppers complaining that high prices were making it hard to buy the company's snacks.
Yeah, over the past couple of quarters, they've actually seen volumes come down, and they've increased their earnings as a result of price increases. This is taking some of that away, and part of this is because of the basket of groceries that people have in an affordability crisis. When the basket starts getting expensive, you start to look for the items that are contributing to it, and you don't put them in the basket. If the prices are lower, you are more willing to put it in your basket. Where is this coming from? Efficiencies, and they're using those cost cuts to lower prices.
And also, it looks like PepsiCo is maybe just losing some market share. Consumers are going for cheaper, some of those brands, like a Walmart brand of potato chips, instead of going for the Lay's. This corporate speak, though, today, PepsiCo aims to boost growth by, quote, offering sharper value to address consumer affordability dynamics, a.k.a. we're losing some consumers right now. We're going to have to lower some prices.
That screams disinflation, but like 2025, 2026 is quickly becoming pick your poison. Do you look at that? Do you look at the conference board data? Do you look at the earnings coming from, say, a MasterCard, which says there's absolutely nothing wrong with this economy right now? Which data do you put more weight on?
Yeah, how do you understand, I hate using this because it feels cliche, but the K-shaped economy? Ultimately, who is putting that Lay's bag of potato chips in their basket and looking at the price? Well, it's not necessarily the person who's going out and eating dinner 4 times a week at pick your own restaurant in a big city. So how do you cater to all of these different customer baskets, if you will, and come up with an average? People say, well, the data is messy. Well, the data is trying to reflect a really motley picture, and you put it together, and right now people are just like, la, 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 I'm going to focus on the earnings because I've got nothing else to do, and we don't even have data coming out on Friday.
No payrolls Friday.
Yeah, exactly.
No data. You're going to have to overweight ADP and some other private indicators as well.
When you hear from Stephen Englander, though, it's like, who cares if we don't get that data, though, because he's basically saying it's not very good. But yeah, this is what happens when you have a government shutdown. BLS workers are at home. They can't prepare the report, and that means we're not going to get the report on Friday. No mention yet, though, of when that's going to be rescheduled. Because this is at the end of when we're supposed to get it, I imagine minimum next week they got to come out with it.
Steve was brutal, wasn't he? If you missed the conversation, he spent like 10 minutes going after US economic data. And then at the very end, took a jab at Europe, because why not?
Yeah, because ultimately they're even worse. And then he said, you know, you fire some Bloomberg News reporters. You have, we're like, whoa, hold on a second. The line has been crossed. Look, ultimately the data is not great. But not having it, people can whine about that too. And there's a real question here about, are we undermining the credibility, or are we just adding to the panoply of private data that we get? We're getting ISM. Yesterday we got ISM. Tomorrow we're getting ISM services. Very exciting. I'm very happy about that.
Looking forward to that as well. Equities right now on the S&P, positive by 0.1%. And coming up this hour, Victoria Fernandez across markets. Investors shake off the noise. Terry Haynes of Pangea Policy as the US and India seal a trade deal. And Vishal Kanduja of Morgan Stanley following Oracle's $25 billion bond sale. Elsewhere, we begin this hour with stocks holding near record highs following a choppy start to the week. Victoria Fernandez across market writing rich equity valuations and lots of optimism set a high bar for positive surprises. Victoria joins us now for more. Victoria, welcome. Does that dampen returns this year?
I think it does, Jonathan. I mean, you walk into a year where you already have PEs above 22 times. You've got really strong earnings, really strong profit margins. You've priced in a lot of this positivity that people are expecting to see later this year. Things from the One Big Beautiful Bill as it relates to productivity, as it relates to capex. All of this is kind of priced into the market. So if we, continue along this path, what is it that's going to make us go higher? Is it continued good earnings? Okay, well, we've priced that in. Is there going to be some kind of a black swan event that changes things? It makes it difficult, I think, to see a ton of upside, although I want to bring some optimism to the show this morning. So I'm trying to be a little upbeat here. We want to be in this market. We want to be invested because we think we will have positive returns. But in our opinion, you're looking at much lower returns than what you've seen over the last couple of years.
Victoria, I think you framed the challenge for investors coming into 26 quite nicely. Is it too early to fade the benefits from fiscal monetary policy and massive capex over the last 12 months and over the next 12 months? Is it too early to do that before we've ever even seen some of the benefits from those three pillars?
There are certain places where I think you can go ahead and trim some of your positions, and those are going to be your really high momentum names. So not necessarily trimming the things that we think are going to benefit from those elements we just talked about, but we came in the year with that broad-based momentum. You look at small and mid caps, we've seen software come back. Now the small mid caps have come back. We've seen parts of financials come back when you look at private credit and insurance. So when you've got this kind of divergence between performance on high momentum and low momentum names, start trimming some of those high momentum names. That's where I would generate some cash and have ready to implement. On some of the other names where you're having higher trends, you're seeing things start to develop. We still like big banks. We like regional banks. You're seeing energy now. Jonathan, 100% of the names in the S&P energy sector are above their 200-day moving average. So I think there's some other places you can put money to work. Trim the high momentum names that have already had that run.
Victoria, is this the strategy for the rest of the year? Essentially just follow the sort of rolling balls of money into one area and then another area and figure out when it's gotten over its skis and then just fade a little bit. And ultimately it's a churn to nowhere. It's a churn to sort of a pretty exhausting small gain.
I hope it's not like that. I hope really, and what we do for our investors that are longer term investors, you have to build that foundation in your portfolio. Those names that can weather some of this. It is a midterm election year. We know it's going to be high volatility. You typically have around a 19% pullback in a midterm election year around the middle of the year. So you have to have a defensive component to your portfolio. You have to be willing to be tactical in the things that you do, but that doesn't mean you're constantly trading and having churn in your portfolio. You have that core component, and you know me, I'm always going to tell you have a little bit of fixed income in there. Well, I think you're going to see a steepening of this yield curve. There's different elements of whether it'll be a bull steepening or a bear steepening, but I think it's going to steepen regardless. So I think you have an opportunity to add some cash flow from fixed income as well.
This really goes to the core of what a safety trade is. I mean, is safety found in precious metals? Is that the ballast of stability after what we've seen over the past couple of weeks? Is it in fixed income where you see long-term bond yields? As you're saying, you're expecting that steepening in the yield curve. I mean, how much of the safety is challenged in addition to some of what momentum is on any given day?
Yeah, I think the definition of safety definitely changes. Lisa, I mean, if you had looked a couple of years ago, safety were these big tech names. It's the Mag 7 names, right? That's where people were looking for safety. And we see what's kind of happened there and concern around some of the capex and how that money is going to be raised. And I don't think you can look at Staples. Staples have had a horrible turn over the last 12, 18 months, although they are starting to build a little bit. There hasn't been a positive trend turn there yet, but there's some positivity there. I think you're looking at companies that have high quality factors. They have decent momentum factors. You're looking at things like big banks, which we like. You are looking at some things like fixed income. And I think you can have some materials and things in there as well with the anticipation that we're going to see manufacturing pick up.
Victoria, when you say you're getting defensive because it's a midterm election year, what is it about the midterm elections that make you want to be defensive? Because a lot of what we're hearing out of Washington is noise and might not actually come to fruition.
It's more kind of looking, Annmarie, at the fact that as you come into a midterm election year, you typically have a lot of policies that have been put in place in order to generate positivity for the country so that they go out and they vote and they keep the administration in place, right? But the problem is that's already priced into the market. It's what we talked about in the very beginning of our conversation. And so as we go through a midterm election year, you have to say, well, what's the next thing that's going to help this market do well? And there's volatility back and forth on that. So you've already priced in the things that you haven't quite received yet, and you're not sure what's coming down the pike, and you get lots of talk, lots of headlines in midterm election years. You get shutdowns like we're seeing right now, and you get data that's missing. So there's lots of that volatility. The VIX tells us that. And when you have a short positioning on the VIX like we saw last week, that puts your equity market in a place where even more volatility can happen when there's bad news. So it's a combination of those factors that typically gives you a pull down, but you start to do better at the end of the year.
Is there a tell in bank stocks? Given everything just mentioned, Anne-Marie's point about a midterm year and some of the proposals, is there a tell in bank stocks? JP Morgan, Bank of America, Citi, all negative for the year so far.
Yeah, they are. But we like these companies and their balance sheets. And to us, when you're going to have a year with a lot of ups and downs, lots of obstacles to overcome, then I think you want a company that can stand that test of time and can stand that volatility. Their balance sheets are top notch. And even regional banks, we've seen them really shore up those balance sheets. So we think from terms of cash flow, from terms of the management of those banks, those are the areas where you can put money to work when you see pullbacks like you do right now. And it's never going to be just always, straight up. You're going to have these moments where these pullbacks happen. But we think longer term, this is a great place to be.
It begs the question, though, why isn't the stock working? Why isn't the story working now? What's leading the pullback, and why does that go away anytime soon?
Yeah, I think right now some of the issues that you're seeing are in terms of the Fed. Are we going to see a policy mistake come out of the Fed? Obviously, Warsh now being named as the potential new head, and there's a lot of concern around there. I'm not as concerned as the market is on these names. I think when you look at Warsh and you look at the Fed, look, either way, if he goes in and says we need to cut rates and he convinces the rest of the FOMC to go along with that, okay, then you get your bear steepening in the yield curve. That's positive for banks and for financials. If he stays with his more hawkish rhetoric that he's had in the past and wants to reduce the balance sheet even quicker, then you have the longer end move up, that term premium higher again, a steepening of the yield curve, which is good for banks. So I think the outlook for banks looks good. And I think there's just a lot of noise right now as to why we're seeing the stocks behave the way they are, because earnings were pretty solid.
Victoria, it's good to see you. Victoria Fernandez across Smart Global Investments. Thank you. Is it Kevin Warsh or is it credit cards? Because Goldman Sachs and Morgan Stanley, those stocks don't have that problem this year.
Yeah, so this ultimately is really a question for a lot of people. How much is the overhang of possible crackdown on huge profits amid concerns about affordability in a midterm election year going to weigh on some of these stocks, especially given how far they've come, right? So this is already coming from a pretty significant place of a rally. It is notable, the divergence between the Bank of America, JP Morgan's, and the likes of Morgan Stanley and Goldman Sachs.
But John nailed it. It's a proposal. It comes from the president's truth. And this has been a proposal in Congress for a lot of senators for years. And guess what? It's not law. So it's interesting they haven't yet made up that space.
The businesses are OK. The companies are doing fine. Victoria talked about the balance sheets. Cool, got that. The stock story is different, and there's just a dark cloud hanging over the stock story because of the proposals of the last month.
There was speculation that some of these big banks could become growth stocks again, that they would be able to have bigger balance sheets, be able to take on more risk, and engage in a way that would allow them to generate profits in the pre-financial crisis era. There is a question about whether that will be hampered by some of the social pressure, and I think that that's what some people are trying to evaluate.
The futures this morning positive by about 0.1%, call it 0.2% higher on the S&P 500. With an update on stories worldwide with your Bloomberg brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump is calling on Republicans to nationalize voting in the United States ahead of this year's midterm elections. In a podcast interview with former FBI Director Dan Bongino, the president saying non-citizen voting is improperly influencing election outcomes. Pfizer shares are sliding in the pre-market after it reported fourth quarter earnings. The pharma giant beat sales estimates boosted by its older drugs as it races to fill gaps from its declining COVID vaccine and pill franchises. But the company scaled back its full-year guidance, seeing tariffs having an impact of around $1.5 billion. PayPal shares trading lower in the pre-market after it reported fourth quarter results that missed Wall Street estimates. The company posting a miss on both the top and bottom lines. PayPal also announcing its CEO, Alex Chriss, will be replaced by HP CEO Enrique Lores. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Vonnie Quinn there with the latest. Up next on the programme, a trade truce with India.
You know, we're making a deal with India, a much different deal than we had in the past. So right now, the tariffs are very high on India because of the Russian oil, and they've stopped doing the Russian oil.
Up next, we'll catch up with Terry Haynes of Pangaea Policy, live from New York City this morning. Good morning. Here's the price action this morning. Here's the scores. Equity futures so far in this session, so far so good, spending the whole session in positive territory, up by 0.2% on the S&P. On the Nasdaq 100, higher by 0.4. Under surveillance this morning, a trade truce with India.
You know, we're making a deal with India, a much different deal than we had in the past. So right now they don't love me, but they'll love us again. We're getting a fair deal, just a fair trade deal. We had pretty unfair trade deals. They're very good negotiators, sir. Just you have to take a look at that, if you would, please. But we're getting close. Well, right now, the tariffs are very high on India because of the Russian oil, and they've stopped doing the Russian oil.
So here's the latest this morning. President Donald Trump getting his deal. The US and India agreeing to mutual tariff reductions. New Delhi promising to halt Russian oil purchases and buy billions of dollars worth of American-made goods. Bloomberg's Tyler Kendall joins us now for the latest. Good morning, Tyler.
Hey, John, good morning. Well, this caps months of negotiations, but with a pretty sizable outcome, right? India is going to see U.S. tariffs on some of its products, in some cases, drop from a combined 50% down to 18%. India ships about a fifth of its total exports to the U.S., so our analysts at Bloomberg Economics say that this should help restore the country's competitiveness since it did not lower tariff rate compared to many of its regional peers. Yet we know India was really lobbying for an even lower rate. In fact, they were aiming for 15%, and the fact that this ended up higher might imply that Washington was pricing in some weaker concessions than originally expected, because as you well know, India was one of those first countries that came to the White House to negotiate. But we really saw the trade talks go off the rails over a number of sticking points, including but not limited to U.S. imports into India when it comes to agricultural products, and then, of course, Russian oil. And while President Trump has outlined the concessions India has made, all we have heard from the Indian Prime Minister Modi is a confirmation of a deal, but no further specifics beyond that. And there are some still big questions on the table, including the scale of reduction from Indian refiners when it comes to Russian energy supplies, because while the White House has curbed those flows into the country, they haven't halted them altogether. The president has also suggested that India could start to import Venezuelan crude, though we haven't gotten any details there and whether or not that is somehow linked to this deal. John, I will quickly point out the timing here. Of course, we saw India last month clinch a long-awaited trade deal with the European Union. That had been expected at that point for years. So interesting to see how the White House has now closed the deal here, as we've seen a lot of allies try to diversify away from the U.S.
A better week for India, that's for sure. Tyler, thank you. Tyler Kendall down in Washington, D.C. Terry Haynes of Pan Geopolicy writing, it's a strong signal that Trump is walking and chewing gum at the same time, not letting geopolitics distract from U.S. economic attention. Terry joins us now for more. Terry, that raises the question then, who's next?
That's a very good question, John. And, I'd look for, among other things, a strengthening of the US-EU deal, which has been kind of on, off, on for, Davos-related reasons. And, beyond that, I would look for probably we should go out and look at Asia a little bit more, where the trade deals can be strengthened even further.
Terry, Tyler mentioned it, but Prime Minister Modi was one of the first officials to come to the White House. It was almost a year ago, February 13th of last year. Yet basically a year later, we are getting a deal. Was damage done in pushing India towards, say, China or Russia because this deal took so long?
There's been a lot of, Modi's got his own politics, of course, but there's been a lot of back and forth and a lot of kind of raw elbows between the United States and India on all kinds of things, ranging from the geopolitical scrapes between India and Pakistan, and frankly, Trump's desire to take credit for the lessening of hostilities there, to the Russian oil, all kinds of other things, many of which Tyler mentioned, and that has made things more difficult than they appeared to be last year when Modi was talking about MAGA plus mega equals MEGA, or MEGA, whatever it was. And but they have had a desire to do a deal for quite a while. It's been obvious that things have been thawing, and I think there's still some prickliness there, but there's a desire to do a deal. The other thing I'd say is that there's a lot of hand wringing in markets always for the lack of detail of these things, and that's entirely fair. But you look at the other way that this has been done in prior years, where deals have been negotiated. They're never finalized. Finally, they're finalized, like the EU with Mercosur, which took 25 years and they're still not done. So markets prefer progress, so that's positive for markets.
Well, when you talk about the prickliness of this deal, the president made it clear they're not going to buy any more Russian oil. We didn't hear that from Modi.
Well, exactly. That's and I made clear when I wrote that the details of this, many details of this, were not final. And I imagine, and I am. This is instinct on my part, I imagine that the timing of winding down Russian oil purchases is the major reason why Modi isn't talking about that. And I also imagine that there are a variety of other details that both the United States and India want, also relating to timing, purchases of what, when, and how, all those sorts of things. And that's about, I think that's the reason why we have kind of a sliding deal here.
Is there a tell in this, Terry, that perhaps the U.S. is taking a harder approach with Russia as a result of some of the ongoing negotiations with European allies about the war with Ukraine and Russia? And I ask this because that's a key component of this deal. India agreeing not to buy Russian crude.
Yeah, I think so. I think it's a major signal from this deal. Trump likes to do what he can to butter up major adversaries, and that gets off-putting for domestic audiences sometimes. But I think there's no doubt that what the United States is doing right now is trying to push Russia and squeeze the lifeblood of its war machine. Then European allies are helping. A lot of the Ghost Fleet activity coming back into European waters has been harassed and more. And so what you're seeing is a kind of a ramped up effort based on what not only the United States, but more importantly, the Europeans are willing to do. They were not willing to, for example, take frozen Russian assets and convert those for Ukrainian use, but they are willing to do that. So the policy is shifting to that, and that will have the usual effect on Russia's economy, but it also makes China's support and pumping up of the Russian client state even more obvious than it is today.
Terry Haynes of Pangea Policy. Terry, appreciate the update. Terry, thank you very much. Rightly or wrongly, many market participants aren't focused on the details of any of this. They're focused on the direction of travel. Tariffs are coming down. They're not going up, and people are moving on.
People moved on even when there were more tariffs that were put on. When there was sort of the suggestion of it with Europe, it seems like people are expecting the temperature to come down, especially as affordability is increasingly an issue in 2026.
Temperature to come down and then potentially go back up. We have USMCA being renegotiated this year. And also, we still have not gotten the Supreme Court decision on IEEPA. Potentially, we're going to get that in a few weeks at the end of February. And does that just create a lot more chaos and a little bit of headaches and head scratching for corporate America?
Biggest surprise of the last 12 months, the tension with Canada. Just did not anticipate that at all.
If you look at Disney earnings, you can see that one of the reasons why they didn't have bigger growth in their parks and recreation business is because Canadians aren't coming. Canadian tourists down 25%. They're not coming to Florida. They're going straight to the Caribbean. People are angry. Didn't see that coming about how much that spat was going to continue.
You're seeing it in the numbers. Equity futures this morning positive by 0.2%. Coming up, each 4% of the Brookings Institution on the doom loop, facing the global economy. Plus, Yahira has your morning movers. Shares of PayPal hammered, down 15% from New York City. You're watching Bloomberg TV. Snapping a three-day losing streak on the S&P 500. Equities up yesterday, up again this morning by 0.25% on the S&P. On the Nasdaq, up by 0.5%. The numbers from Palantir, decent. The debt issue, $25 billion from Oracle just yesterday, well received. Lifted enthusiasm for that whole ecosystem in the last 24 hours. And moving on pretty quickly from that explosion in precious metals, gold, silver up nicely already this morning. In the bond market, 2s, 10s, 30s shaping up as follows. Going into the data. What data? No payrolls Friday, no JOLTS data, I believe, either. we're waiting for ADP and ISM services over the next few days.
Yeah, it's ADP and ISM services Wednesday, and I'm so excited for it. I'm going to be 100% there for it. It's the reason why you saw such a significant move yesterday on ISM manufacturing, because guess what? It's one of the few data points that we're actually getting, and it does suggest that we're getting a rebound in some of the key areas that President Trump has been pushing for. Let's see if we see something similar in services. Can we get excited about ADP and ISM services Wednesday? I'm going to try.
We'll try to. The good news is you don't have to pretend, because ISM services comes out when we're not on air. But that is a data point I'll look to. ISM manufacturing was good. It was solid yesterday.
I don't pretend. I get genuinely enthusiastic.
Everything about it is authentic.
And I will be genuinely enthusiastic at 6 a.m. the next morning.
Nothing disingenuous about any of this at all. 10-year bond yields near the top end of the range for the year. 10-year bond yields this morning, 4.28. With an update on movers in the pre-market, your morning movers. Here's Yahara with more. Hey, Yahara.
Hi, John. We start with PepsiCo. Shares are falling 0.75%. The company did beat on earnings, but it was only a slight beat. And with the stock up about 8% year to date, investors may have been looking for more. We also have the Wall Street Journal report saying that the company plans to slash prices by as much as 15% on products like Lay's potato chips as they try to win over those price-conscious shoppers who the Wall Street Journal reports have been calling into PepsiCo to complain about the high prices. Meanwhile, we have PayPal shares plunging in the pre-market, down 15.5%. Let's start with the earnings, which seem to be the main catalyst because they were pretty rough. The payments company missing on both the top and bottom lines, and the growth picture doesn't look good either. So for that reason, they have chosen to make a shakeup at the top, appointing the CEO of HP, Enrique Lores, to lead the company as CEO. He will replace Alex Chris, with the board chair saying that the pace of change and execution by Alex was not in line with expectations. And we end on U.S. rare earth stocks. They are bucking the trend up in the pre-market. Critical metals up nearly 6% after President Trump yesterday announced a $12 billion strategic minerals stockpile, the first of its kind for the U.S. private sector. All of this part of an effort to reduce reliance on China, which dominates the market with an estimated 85% of global processing capacity. John?
Yahara, thank you. Thanks for the update. More from Yahara in the next hour. On our radar this morning, the BLS delaying the release of the January jobs report due to the partial government shutdown. High Speaker Mike Johnson saying he expects a continuing funding measure to reopen federal agencies will be passed later on today. Elsewhere, President Donald Trump saying the criminal investigation into Fed Chair Jay Powell will continue, quote, to the end. Republican Senator Tom Tillis declaring he'll oppose any new Fed nominee until the Powell probe is fully resolved. And finally, one to take note of, Australia becoming the first major economy to hike rates this year. The Reserve Bank of Australia expecting core inflation to peak at 3.7% in June. Many economists expected the central bank could deliver another hike in May.
Yeah, they raised their growth and inflation forecasts during this decision. They raised rates to 3.85% from 3.6%. What is different about Australia? This is what's interesting to me. They are at the epicenter of this whole sort of revenge of the real world. They produce some of the greatest volume of iron ore, of coal, even of silver and gold. They have all of these mines. And so ultimately, their economy has been bolstered by this. It is just Australia and Japan. Everybody else is in a holding pattern, but it does highlight how it does seem like these divergences are growing in a world that is incredibly multifaceted. I mean, really, the different kind of influences here are amazing.
It's a fascinating time in financial markets. One of the reasons, of course, that Australia and the Aussie dollar is the best performing currency in G10 over the last 12 months. They want inflation in a band of 2 to 3%. Inflation's closer to 4 than it is to 3. That's a problem. I'd throw this out there, too. They've got a big problem domestically now with the politics of the mortgage market and housing. Housing in Australia is absolutely ridiculous, and rates are going up in the wrong direction for a lot of people who need to service some of those houses.
This is the reason why you look at the economics and it looks really good, and then you look at the politics of it and how this sort of plays into it. And I think that increasingly this is going to be the discussion. How do you get 6 months, 12 months down the line in terms of the policy response at a time where there is a dual mandate for all of these central banks? They're facing off with people who cannot afford their lifestyles at the same time that the overall economies seem to, at least in aggregate, be booming.
Governor Bullock calling the situation unacceptable down in Australia. Let's turn to trade. President Donald Trump striking a new deal, lifting tariffs on India. The world now 1 year into President Trump's push to remake global trade in his second term. Ishwar Prasad, senior fellow at the Brookings Institute, offering a clear-eyed account of the forces at play in his latest book titled The Doom Loop, Why the Economic Order is Spiraling into Disorder. Ishwar joins us now for more. Professor, it's good to see you.
It's good to see you as well,
We
Jonathan.
bumped into each other in the last few weeks, and I think it's fair to say this is not the book you wanted to write.
This is indeed not the book I plan to write. I plan to write a much cheerier book about how we are moving from a unipolar world after the collapse of the Soviet Union, where the US became the dominant power in every respect, economic, military, financial, to one where economic power at least is more evenly distributed across countries. As an economist who instinctively one thinks competition is good for efficiency, balance, and stability. But it turns out that the forces that I thought would lead us towards a stable equilibrium, and perhaps now we're just in a period of transitional volatility. As I thought about it, it occurred to me that each of these forces is in fact engendering more instability rather than stability, and therefore the doom loop.
When did you finish the first draft?
October of 2024. And at the time, it seemed like the book was a little too dark. So I said, let's wait for the November 2024 elections, maybe rethink the thesis. Because, my heart was pulling in one direction, which was a positive direction. My head was pulling in the other direction. But then, of course, everything that has happened over the last 14 months has validated, if not turbocharged, the thesis of the book, sadly for the world.
The last 12 months is questioning a lot of what we were taught in international relations. In fact, if you go to the textbooks, they'll tell you that the era in which the British Empire and Britain maintained the global order followed onto the era that America led the global order. And a lot of that changed because Britain no longer had the economic means to maintain it. The situation here that I think is rather unique in economic history is that we have an unwilling hegemon. It's a hegemon that actually has the power to maintain it, but is unwilling to do so. How unique is that?
It is a very odd time in the world because there are two superpowers. One, as you said, is seeming to want to cede its role as the global hegemon, providing global leadership. The other superpower needs or is trying very hard to establish its position. But the problem is that the rest of the world, everybody is stuck in the middle powers, seem to view both of these as untrustworthy, unreliable allies. So they're sort of bouncing between each other. So that's where the instability comes from. Rather than these two forces basically stabilizing each other, with the middle powers adding some stability, each of the middle powers is actually creating even more instability because you're teetering from one side to the other.
Why are you not seeing this more in markets? We saw occasional flare-ups of sell America, of sell the dollar, of a weaker dollar. We did see that last year, but not necessarily a wholesale exodus. Why are we not seeing it in a more significant way if this really is coming to pass?
So the doom loop is about how economics, politics, and geopolitics are stuck in this negative feedback loop. But it turns out the doom loop is not inconsistent with things looking very good on the surface. In fact, it's when things look calm on the surface and there are tensions building up underneath that you have potentially worse outcomes. And we may be in a similar moment. And certainly the US is in some sense unique. It remains a very dynamic economy. Although the institutions are being frayed before our very eyes, it still has relatively strong institutions. And it's been able to generate one thing that no other major advanced or emerging market economy has been able to since the COVID period, which is enormous productivity growth. When productivity looks so good and we don't fully know why this is happening, that makes everything add up. It could be AI, it could be deregulation, but there is something fundamental about the dynamism of the US economy and the fact that no matter how weak it seems in terms of institutions, in relative terms, it still looks pretty good compared to other countries.
How do you see the doom loop manifesting itself down the line? I mean, we've heard the Ray Dalio line of thought of civil war and all sorts of revolutions as you get sort of one great behemoth getting passed to another hegemon to rule the world in a certain kind of way. How do you see it kind of evolving?
So I'm an economist, Lisa, and certainly I know that economics, domestic politics and geopolitics go on parallel tracks and occasionally they intersect with each other. But we are at a moment right now where these are intertwined in a way that is very difficult to separate, which is why as an economist I'm venturing into this broader territory. But there are times when this feedback loop is positive. During the 1990s, the 2000s, there was a sense that this feature of globalization, for instance, might work well for everybody. There would be a positive-sum game that would offset the intrinsically zero-sum game of geopolitics. But now even globalization, especially trade, is seen as a zero-sum or negative-sum game. And that means that there is no balancing force to geopolitics anymore. So this is why I fear that we are stuck in this loop where essentially each of these elements brings out the worst in each other rather than the best.
Are there not any positive outcomes, though? NATO is spending more. Europe is trying to do more in terms of the Trump administration pushing them. There might be a deal on Greenland. This administration is going after rare earths, where China absolutely dominates, not just owning them, but processing them. Isn't some of this also positive in terms of feedback loop?
Certainly, Annmarie, moments of crisis can sometimes bring out the best in countries. And for instance, in the case of Europe, when its territorial integrity is threatened, as was the case with Ukraine or with Greenland, Europe, stiffens its spine. The question is whether there is a political will to do what is necessary to do the positive things that are necessary to improve productivity and growth in the economy. And there, the internal dissensions within the Eurozone seem to be holding things apart. So it is true that there are times when we might be able to pull these dynamics in a positive direction. But as I argue in my book, what it's going to take is very engaged citizens, business community, and national leaders who can help us see beyond our short-term prejudices, and better institutions, domestic and international.
I feel like Prime Minister Mark Carney read your book because this feels part of what he was talking about in Davos with his speech. How are middle countries, in terms of what you're seeing, deciding on whether or not to get closer to Beijing or to stay with Washington?
They are stuck between these really unsavory alternatives because, the U.S., as we were just discussing, is receding from its role of providing leadership. China's not quite trusted anymore because of its institutional framework. So take India, it is using this approach of what I call issue-based alliances. When it comes to the matter of cheap oil, it sticks with Russia and China. But on the other hand, it sees its fundamental values as aligned more closely with the West. So India could be a balancing force, but it's not quite happening. And if you look at the middle powers, and unfortunately I put Europe in them because it could be a great power, but it's not ascending to it, they have a lot of dissimilarities. Rich, poor countries, small, large countries, they should be coming together. But as Mark Carney said, the pragmatic approach might be these issue-based alliances, but that doesn't build deep-rooted alliances that will stick through difficult and good times.
Professor, what do you think went wrong? What do you think went wrong? How did we get here?
That's exactly what the book is about. I think the reason the feedback loop turned negative is if you think about the benefits of something like globalization, as we economists recognize and measure them, at the aggregate level, they were very good. But there was a disgruntled class of people who felt that they were left out, not just in terms of losing jobs, but in terms of losing opportunity. And what they saw was that the benefits were going to the economic and political elites, and they didn't need to do anything illegal or illegitimate. They just captured the political process. So that infected domestic politics. And that in turn is now affecting geopolitics, as we can see in the context of the US-China relationship, but even the US relationship with traditional allies like Europe and Canada. So this is where the loop is going to be very difficult to get out of, again, unless we have the corrective mechanisms working well, and that's going to take better institutions.
Professor, it's good to see you. Book on sale today?
Today, indeed.
Best of luck with sales, sir. We appreciate your time. I've got a copy on my desk. I'm going to start reading it today. Ishwar Prasad of the Brookings Institution, author of The Doom Loop, Why the World Economic Order is Spiraling into Disorder, something you and I have discussed quite a few times. What globalization did to manufacturing. What will AI do to services?
Yeah, you start talking about the aggregate numbers that look okay and then people not feeling okay. It kind of is deja vu all over again when you take a look at what's going on right now. And it's the reason why you're getting a lot of political pushback to some of the AI initiatives that we're seeing.
That's the next book, isn't it? Maybe. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. Secretary of Homeland Security Kristi Noem is requiring that all the department's officers on the ground in Minneapolis wear body cameras. The Secretary making the announcement yesterday on social media. President Donald Trump saying he thinks it's generally good for law enforcement to wear cameras. President Trump says he's seeking $1 billion in quote-unquote damages from Harvard University after the New York Times reported that his administration had backed off demands for $200 million to satisfy accusations of wrongdoing by the Ivy League institution. Trump called the Times article, quote, completely wrong. Today's show host Savannah Guthrie's mother is missing. Nancy Guthrie was last seen on Saturday near her home in Tucson, Arizona. Police in Pima County believe she was abducted from her home while she slept. Officials say the disappearance is being treated as a crime and are urging neighbours to check home surveillance footage. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate the update. Up next on the programme, Big Tech's Debt Binge.
This AI spending trade is getting an audit right now, and the audit is telling you if you have leverage on balance sheet and you're committing to spend, you better have a way to demonstrate to investors that there's some monetization.
That conversation up next with Vishal Kanduja of Morgan Stanley from New York City. You're watching Bloomberg Surveillance. Stocks are up by a third of 1% on the S&P 500, up by 0.5 on the Nasdaq. The Russell small caps up by a third. Under surveillance this morning, big techs, debt binge.
There's a lot of stocks that are triple B or below that have committed to a lot of spending. This AI spending trade is getting an audit right now, and the audit is telling you if you have leverage on balance sheet and you're committing to spend, you better have a way to demonstrate to investors that there's some monetization or some return on that investment. If not, you're gonna kind of be punished in the credit market.
So here's the latest this morning. Oracle easing fears of an AI debt bubble by outlining fundraising plans split between equity and credit markets. Vishal Kanduja of Morgan Stanley writing, we view the spend from a cautious debt holder vantage point, negative overall, but have idiosyncrasies, overweight in certain issuers. Vishal joins us now for more. Vishal, good morning to you.
Morning. This
is my very amateur understanding of the last 24 hours. So there was an equity component to the capital raise. So debt holders were happy and equity holders were happy because debt holders were happy. Is that the way things played out in the last 24 hours?
A little bit, but there was commitment from from the company about IG ratings. I think if you take a step back, they issued in September. Spreads widened probably about 100 basis points, almost pricing mid-double B levels. Lack of certainty about how much they want to issue. And then all the multi-layer contracts that we can question about as well. Then they come out, listen to the debt holders. Yes, you cannot do this without destroying your own capital structure. Bringing in equity issuance, even when the stock is down 50, 60% at these levels. So there is significant commitment to investment grade. And that's why spreads have snapped back. Now, again, spreads are not as tight as some of the AA hyperscalers out there, 70, 100 wider. I think double B spreads are on an index level 155. I think the 10-year here is probably about 140, 145. So still not out of the woods. So there is definitely risk being priced in.
So we're sitting there straddling the dividing line between junk and investment grade. And typically when capex is assigned or tied to a multi-year contract, that's not speculative, particularly when the company has a strong balance sheet. Now, that's where there is a big question mark, because this capex is tied to multi-year contracts with a range of companies, but the one that's in the spotlight is OpenAI. How speculative is that story?
Definitely, but I think you're seeing quite a bit of earnings come out where cash flows are real at this point. Yes, I think when you extend out an NPV, some of these cash flows are still negative, and I think some of the equity raises will help on the other side to allay those fears. And that's why I think you're pricing in probably double B type of levels on the overall debt here. So you're not pricing in AA or single A type of levels. I think one more piece, if I could make, what is happening, and probably if you look back, probably last 5 to 10 years, or probably 15 years, going back to 2008, the financial crisis, the makeup of the indices matters a lot because there's quite a bit of passive money going in. Now, all this AI capex infrastructure with these long bonds, you're going to have 5-7 extra % market value and spread duration in equity, fixed income indices that passive buyers cannot just ignore.
Let's build on that. There was a Bank of America survey of credit investors recently that showed that the majority expect hyperscaler-related investment-grade debt to be somewhere between $100 and $300 billion so far this year. We're seeing the composition of what's considered investment-grade change as a greater proportion comes from some of these hyperscalers. Does that make investment-grade riskier?
Absolutely. I think you're going through a time period between 2003 to 2005 where you had basically balance sheets peaking out in credit quality. You're having the same issue right now because of the issuance. Now, again, the starting points are extremely, extremely solid, where you have companies who've gotten probably 7 to 10 years of extreme amount of cash flows in there. They're sitting at AA, AAA levels. I would say that if some of these hyperscalers came out yesterday, we saw one of them, the lower quality one, but if the higher quality comes out, they'll have more sort of debt book build up more than 30-year treasuries at this point. So the starting points are extremely solid, but yes, you're in the deterioration of credit on some of these parts.
How do you explain the volatility that we've seen in the metals market, the volatility in headline risk, the volatility that we're seeing in sentiment, and then a global bond binge that is unprecedented so far to start 2026? We've already seen more than $1 trillion in total issuance coming from governments and the likes of financial companies and the likes of Oracle. How do you square those two ideas?
Quite a bit going on. So I think if you can take a step back and parse it out, we think that there's a Besant moment happening with Walsh's, at least the nomination. I think we still have to go through the clearing of that. I think there were 3 or 4 individuals who were in the running, more considered to be very close to the White House, and then you picked a person who supposedly, at least on paper, can build a lot of consensus that it needed in the divided Fed. That's why you saw a massive sort of move in the dollar, curve steepened out because Walsh is going to be very dovish for the front end, very hawkish for the back end on that part. And then the dollar regains a little bit, at least momentarily, a little bit of credit back that it had lost over the last 2 months. I think also what is happening, if you can take a step back, you go back to 2008, 2005, where these Fed swap lines were given out to different central banks. I don't think that the global central bank sitting in Europe or somewhere other part of a developed world can confidently say that if they're going through a credit crisis, that they can put in a call to get extra dollars. That's why you're seeing a massive amount of flow into debasement trade, whether it's cyclical currencies, whether it's the gold, etc. And now the issue with volatility is you have a market that has extreme amount of liquidity and buyers and sellers in it, which is about 30 trillion of US treasuries, that you're taking a piece of that market and it's moving into very tiny markets on the other side. Gold, 5-10% is outstanding for
Is that debasement or diversification? And is that a distinction without a difference?
I think there is definitely a distinction. Great point, John. I think we think it is diversification at the moment, but it is coming from extreme amounts of over allocation to the US dollar over the last 15 years. I think so. Initial part will definitely be diversification, but there will be more avenues that investors.
Shouldn't that show up in risk assets eventually?
Eventually, it should be cost of capital for the U.S. Treasury, and then high quality debt, and then low quality debt would slowly increase. But I think the fundamentals overall in the U.S. economy still are pretty rock solid on the other side. And that's why you're seeing even if it is $1 trillion of supply coming through, books are still 4 to 6 times oversubscribed.
We've seen that in the last 24 hours, that's for sure, with that one debt issue, $25 billion from Oracle. Vishal, Clinic, good to see you. Lots to think about. Thank you. Vishal Kanduja of Morgan Stanley. Morgan Stanley calling the appointment of Kevin Walsh a stabilising event. A stabilising event for this market and some of those trades, those explosive moves we've seen in precious metals.
Yeah, a Besant moment, maybe drawing more people into the fixed income market by expecting more stability based on some of the past expectations from Kevin Walsh. I'm sitting here thinking about how Eswar Prasad and Vishal Kanduja are having very similar kinds of, the world is changing. It doesn't look like that. It's got a very stable surface, but right now the world is changing before our eyes and it will gain steam. That's sort of my takeaway.
All these little convulsions popping up in different markets, seen it in JGBs and precious metals. When are we going to really see it show up in credit markets and equities? Because we haven't seen that just yet. Coming up, Dan Greenhouse of Solos, Jay Goldberg of Seaport Global, Yelena Shuletseva of the Conference Board, and Chris Harvey of CIBC. The third hour, up next.
We were seeing AI jitters coming back into the market.
The risk atmosphere is elevated.
If I broke tech down, the dispersion between the haves and the have-nots are almost unbelievable.
People should not be so concerned about the absolute increase in overall market capitalization. The concern should be the concentration.
Earnings growth is the last engine of return. And look, it's still on. That engine's still going.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures on the S&P up by a few tenths of 1%, up by 0.5 on the NASDAQ. Tech earnings in focus tomorrow and the day after. Waiting for Alphabet, waiting for Amazon. You'll notice the week ahead picture has changed a little bit. On Friday, no payrolls data. things are a little bit lighter now, given the government shutdown.
So we're going to be having a greater emphasis on ISM services and ADP data coming out tomorrow. And frankly, the earnings are getting the due they deserve, because that is probably the most reliable data that we can get right now. And it's not just what we get in the results, but also how the market responds to it. What we saw with Meta before, as well as Apple, is spending isn't always good. That, I think, is going to be what to watch for the likes of Amazon and Alphabet.
Tech at the moment, look, hardware versus software, very different performance dispersion within Mag 7. Take Meta versus Microsoft just last week. Anything but snoozy for these tech earnings right now. And you just wonder what the picture looks like by the time we get to the weekend. Alphabet versus Amazon.
Yeah, especially at a time where you haven't seen big tech reprise some of their all-time highs that you saw late last year. So there does seem to be this bigger question hanging over markets. Can you get momentum back into the equity indices if you don't have the participation of big tech? This really is the ultimate litmus test. How do investors respond to some of these earnings?
And it's almost interesting now, more so, because we have this spat, what's going on with NVIDIA and OpenAI behind the scenes. It seems like Jensen Huang is questioning OpenAI and not really going full gangbusters in. And at the same time, behind the scenes, according to these reports, Sam Altman is saying, well, actually, we're looking for alternatives because we're not quite sure about those chips. And what does this mean for the other tech hyperscalers?
Yeah, they are, let's just say, offended maybe by the Wall Street Journal report that Jensen's not impressed with the way they're spending money. Is that fair to say?
I think that's fair to say. I think that is the reason why you're getting that lash out with respect to maybe some of the Reuters reporting that, guess what, we don't like your chips anyway. But at the end of the day, it does seem like OpenAI is in a different zone, and it really remains to be seen how much it is increasingly a liability for some of the big tech companies that have been investing in it.
Stocks positive this morning by 0.25% on the S&P 500. Coming up, we'll catch up with Dan Greenhouse of Solis, with stocks trading near all-time highs. Jay Goldberg of Seaport Global looking ahead to a big week of big tech earnings, and Chris Harvey of CIBC anticipating a Walsh-led Fed to favour Main Street over Wall Street. We begin this hour with stocks pushing towards fresh records driven by a strong start to earnings season. Dan Greenhouse of Solis writing the following. Results are on balance better than expected. Nothing in the hyperscaler reports suggested an AI slowdown. Dan joins us now for more. Dan, good morning.
Good morning to you, sir.
Let's get to tech, and we talked about that dispersion. Meta versus, say, Microsoft, and within Mag 7. Then you've got software versus hardware. How difficult is it to approach this sector this year?
It's obviously quite difficult. But I have a differentiated view on this.
Please do.
I think if someone in the control room could throw up a 5-year chart of Oracle, let's say, I don't think that's a bad-looking chart. Obviously, there's an issue going on right now, and the point I've made repeatedly for the last year or so is Oracle's very much its own thing and what's going on there, as is the case with Salesforce and Adobe, let's say. But the charts of Adobe and Salesforce, in terms of the software conversation, look way worse than a lot of other names in tech. And in the case of Oracle, which is getting lumped in a lot of respects with the carnage across tech. So here's the chart of Oracle. Yeah, it's 50% off its highs. Thank you, control room. Yeah, it's 50% off its highs, but I bet an investor over the last couple of years is perfectly happy with Oracle's performance annualized over that time frame. And listen, there's a lot going on. They're raising $50 billion yesterday, obviously. They've got to play catch-up in terms of building out the hyperscalers to meet its contract with OpenAI. And there's a lot of worry about that and its higher leverage levels. But again, as a long-term investor in Oracle, you're probably not too upset.
So let's just take the last 12 months and park the last 5 years, because the last 12 months is far more interesting,
Sure.
particularly the last 6. The capex build-out, how speculative is that capex build-out? That's been the number one question throughout this morning. And I understand people are a little bit more comfortable with the capital raise of the last 24 hours or so, but where do you actually stand on the fundamentals of the company and the way it's priced at the moment?
I'm not a particularly large tech investor. We don't own any of these large tech names. That's pretty clear. But I read through all these earnings reports. They all look pretty good to me. I think a lot of the variation in terms of price movement on a daily basis is a function of expectations versus reality. But when you step away from that and look just on an absolute basis, all these companies are doing pretty well to varying degrees. In terms of the investment, we're getting hundreds of, I think now the hyperscalers are going to do about $640 billion worth of capex this year, some number like that. I'm positive a lot of this is lighting money on fire. The question is, when does that fire go up, so to speak? And as an investor, it's the issue that you struggle with the most, because we've talked about the late 90s before. People were talking about a bubble in the infrastructure build out in the 90s, in 1995, in 1996, in 97, 98, and so on. And it wasn't until 99 when things went absolutely just insane in the back half of the year that people started to point to certain things that were legitimate worries. The time has come. I think the problem you have as an investor now is you look at this level of investment, you know some of it's going to be malinvestment and wasteful, but there's no indication as of now that it's slowing down. You just need to look at SanDisk's most recent report, for example.
There's an extra wrinkle here, which is that the spending that they're doing has fueled GDP.
Sure.
The spending that they're doing is supporting the entire economy, and without that, arguably, we'd be in actually a pretty weak economy.
So, I disagree with that, but okay.
Okay, well, please. No, actually, I'd like to go there. And how do you sort of back out some of the ongoing capex spend from some of the big tech players and figure out what's left over?
So I've done a little bit of work on this, but I'll defer to Goldman, who did more work than I did. And I think Jan has a report out in the last couple of weeks or months making the case that this is completely overblown from his. I may not go that far, but that obviously, AI and the investment has been contributory to GDP, no denying that. But the degree to which some people are arguing that it's half of all growth or 3/4 of all growth is overdone. The limited work I've done sort of corroborates that as well. I come down on the side of...
Well, can I just ask you what number you put it at? Because I think Michael Semblas of JP Morgan put it at about 40%.
Yeah,
about 40% of the growth of the first 3/4 of last year.
Yeah, I'm probably close to a third or a quarter. It's
so substantial.
Yeah, but it's not some people saying GDP would be cut in half or dare I say recessionary. Not that you just said that, but I'll build the straw man for a moment here.
Thank you. Go ahead.
So for me, I've always come down. Listen, this is still a consumer-led economy. It's not the 70% that everybody says, because you need to X out a couple of items, but the consumer's doing fine, and to me, that and investment is what's driven GDP over the last couple of quarters. And as I mentioned earlier, nothing in either the AI reports, the Metas and the Microsofts tell me that story is slowing down. And when you look at the likes, we don't have too many consumer companies yet, but when you look at MasterCard and Visa and American Express, who see spending across destinations, all told us that the consumer's basically fine as well.
Sure, people can fly to Fiji, but they can't buy Lay's potato chips unless you lower the price, right? I mean, this is sort of essentially the conundrum for the past couple of years. Yes, we did see American Express and the credit card companies come out with really good results, but then Pepsi today is talking about 10 to 15% price cuts across the board. Flaming Hot Cheetos, John's favorite, is going to be cut in price.
Right.
I'm just wondering what the signal is for you. I mean, how strong is a consumer that needs price cuts in order to keep buying Lay's potato chips?
So there's two conversations here, and there's no way to do this without offending somebody, so I will try my best.
No, offend someone.
There is two conversations here. One is me as an investor, and then one is me as like a human being living here on Earth. Obviously, you want everybody to participate in growth. And the idea that lower-income consumers, and the reality that lower-income consumers are struggling in this environment, from a human standpoint, is obviously a problem that needs a solution, for sure. The consumers, you mentioned Pepsi, the consumer staple companies, for 2 years now, you go through their reports, and all their sales increases are price. Volumes have been going down forever and ever. From an investor standpoint, and this has sort of been my argument for 2 years now, I don't care as much. And that's...
I'm offended.
It could be, there's someone watching might be offended at me saying that, but I have to invest in the world as it is. And as much as I care about, obviously, everybody participating, capitalism is about that to some degree. As an investor, it matters much less to me.
Isn't this the year where investors have to take note? Because the president is now taking note and introducing remedies to this problem that could have consequences for markets.
Crisis.
Absolutely. The cloud that's hanging over the JP Morgan, Citis and Bank of Americas of this world right now, the fact that those stocks are trading negative, and a lot of people would say the difference between Morgan Stanley and Goldman and that bucket of stocks and the other bucket is some have credit cards and the others don't.
Sure. Listen, obviously the president has taken aim at credit card rates. I don't think anything's going to get done there. Like, I certainly don't think I'm in the minority. I would just note, the big banks are in trouble, but the regional banks are doing quite well. Wells Fargo's down, Citigroup is down, that whole group is down. But the KRE is up on the year, called 4 or 5% or something like that. The affordability crisis, I care very much about it from a human level.
No, I get that. No, I'm totally with you. Tomorrow's prices don't care about your politics or your feelings.
That's right.
I understand that, but tomorrow's prices care about policy. and the policies that are being introduced right now, whether you think they're going to go through or not, are having consequences for stocks.
Well,
I think that's the conversation we're trying to have.
Sure, the president's trying to jawbone this, and deservedly so. The housing story is probably the biggest issue at the center of everything that's going on in politics and markets right now. On my LinkedIn page, I've talked about this repeatedly. The politician that tries to address the housing story most convincingly is going to have a following to an nth degree larger than everybody else, because it is the death of capitalism, young people's lack of interest in democracy, and then tilt towards communism, socialism. At its core is the inability to buy a home or live the quote-unquote American dream. So I'm all for it. But at the same time, you do have the president saying, I don't want home prices to go down. So there are conflicting...
But it's not just credit card. It's not just housing. It's going after the defense sector on buybacks and dividends. It's taking equity stakes.
The chart of Lockheed Martin does not tell me that's too much of an issue.
Well, it's also taking equity stakes and picking winners and losers of certain companies. ISM, you look at some of this commentary, confused and uninformed tariff policies continue to plague small companies. Don't you have to care about this and actually make an investment decision based on it?
Yes, we pay attention to all of this. The question is, you have to, in the hierarchy of concerns, a phrase I've been using for some time here, as an investor, what matters most? And it is the fundamentals of the company. And there will be times where a politician, in this case the president, saying let's cap credit card rates or let's subsidize cash for clunkers type programs has an effect on the investment landscape. But as fundamental bottom-up investors, ultimately, the fundamentals of the company are what matter. And so the types of companies we invest in, you want to be generally speaking, you want to be as far away from this as possible. You don't want politicians meddling in your investment process, either on the positive or certainly not on the negative. And for a lot of investors, we have learned after 10 years of this to filter out what is consequential, what is going to matter, what is going to have an effect, regulations, executive orders, et cetera, and what probably won't, which is I want credit card rates to be lower when it actually takes an act of Congress to do that.
It's funny, I thought of you when that MasterCard report came out. I was like, Dan Greenhouse would be looking at this and not the numbers from the conference board.
Yeah, this essentially is what we've continued to see, is people looking away from some of the classic indicators because of exactly this.
Do you want to thank the control room just before you go?
Thank you for quickly having up but this is why the crack control room here at Bloomberg Surveillance.
Bobby's quick, right?
If there was an Emmy Award for chart...
ticker knowledge.
Chart ticker manifestation. I think this Jim in the control room, because there's certainly a Jim, is there not?
Yeah, no, there's a Jimmy and a Bobby.
Jimmy and a Bobby.
Both getting it done.
Of course.
And
Dan,
Freddie.
Thank you. Yeah. Dan Greenhouse, appreciate your time. Thank you very
guys.
much. Of Solus Alternative Asset Management. Let's get you an update on news worldwide. Your Bloomberg Brief with Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump is pushing House Republicans to accept a deal he struck with Democrats to end the partial government shutdown. In a post on Truth Social, Trump told lawmakers to swiftly pass the measure with no changes. The bill would fund most agencies through September and the Department of Homeland Security through February 13th. Elon Musk is combining SpaceX and XAI at a $1.25 trillion valuation. Musk says the company will work on AI, rockets, space-based internet and other technologies. Sources telling us here at Bloomberg the company is still planning an IPO later this year. The offering could raise as much as $50 billion in what would be the biggest initial share sale to date. Former President Bill Clinton and his wife, former Secretary of State Hillary Clinton, will appear before a congressional committee investigating Jeffrey Epstein. The House Oversight Committee had planned a full House vote to hold the Clintons in criminal contempt if they continued defying subpoenas. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next, the morning calls, plus Jay Goldberg of Seaport Global looking ahead to a big week of big tech earnings from New York City this morning. Good morning.
NVIDIA continues to have the best ecosystem out there, whether it be the hardware they produce or whether it be their software ecosystem. You've got OpenAI making commitments with everybody here over the last 6 to 9 months. And in reality, it doesn't matter necessarily to NVIDIA who wins this game at the customer level, but they want to be involved, I think, across the board.
That was Angelo Zeno of CFRA from New York City. Welcome to the program. Your scores look like this. Futures positive by 0.25% on the S&P, and the Nasdaq 100 up by 0.5. That's your price action. Here are your morning calls. First up, Citi, upgrading JetBlue to neutral, seeing upside risk for the shares. That stock is up by 2%. Your second call from Baird, upgrading Palantir to outperform following earnings. The firm saying Palantir's guidance implies further growth acceleration. And finally, Mizuho, raising its price target on Alphabet to 400 ahead of earnings. The firm seeing potential for the online advertising market to accelerate in 26. That stock is up by 1.2%. Let's turn back to one of our top stories today. Elon Musk consolidating his empire, combining SpaceX and XAI at a $1.25 trillion valuation. Bloomberg's Ed Ludlow has more for us. Good morning, Ed. What a valuation.
Yeah, the math is worth mathing on. My understanding is simply an all-stock transaction that values the SpaceX part at $1 trillion and the XAI part at $250 billion. And on a technical basis, XAI just becomes a subsidiary of SpaceX. There are lots of questions about the debt pile that SpaceX is taking on because XAI had a lot of debt. But, this, to the mind of like all the investors that I've spoken to, both sides of the table, is completely logical. It is a jump from SpaceX's prior valuation of $800 billion in the tender it did at the end of last year, a tender being a chance for employees to sell their own shares in an insider transaction, and a slight jump on XAI from the $230 billion on the equity raise they did in their Series E. But, the totality of it, the bigger picture is so much more than that. And are we still headed for that big IPO in June?
Well, Ed, that's the question for me. We got this big, staying private. What is the need to go public?
Yeah, I'm kind of teeing myself up a little bit, but my understanding is they are fully on track for that IPO later in the year. The big picture here, the reason why Elon Musk is doing this, XAI and SpaceX, is frankly, Musk believes that on Earth, AI is constrained. It will break the grid. There is not enough energy and not enough space for the data centers. In space, there is literally enough energy from the sun and enough space to accommodate all of it. But the reason that the IPO has to go ahead is that the rationale was always to raise tens of billions of dollars to buy the GPUs. Whether your data center is a satellite form factor in orbit or it's here on Earth, that's the expensive part, the content relating to the accelerator. And that's what they know they need to do. It's just they're now doing it as this kind of wider vertically integrated company where SpaceX through Starship has a rocket capable of putting those satellites into orbit. XAI has the technical expertise to develop the models. And then I guess the next question that many still have is, where does Tesla fit into this?
You can answer that yourself if you want, Ed. No, we don't have any time. It's good to see you, buddy. Right. Thank you, Ed. Thank you. Thank you very much. More from Ed a little bit later. Look out for Bloomberg Technology later on this morning. $1.25 trillion. Just think about that. Remember what we used to call a unicorn? Billion-dollar company in the private market. Give me a break.
Now unicorn's $1 trillion, and that's just one part of this company, because SpaceX is $1 trillion, and then XAI is the next 250 billion.
Amazing.
Shocking.
Let's stick with tech. Another big week of earnings on deck with AMD reporting after today's closing bell. Jay Goldberg of Seaport Global writing, as long as the big capex spenders keep up the pace, the market will likely look past the many obstacles ahead. Jay joins us now for more. Jay, what's the big obstacle for you and the team?
The list is long and getting longer. This is going to be a year of constraints across the landscape, right? The big one is TSMC capacity to actually manufacture all these chips. They're bumping up against their limits. We see disruptions in the grid and getting electricity and construction for data centers on time. The whole industry just feels constrained.
Raises a question, Jay. Has that been priced in? Because we've already seen a bit of skepticism being priced into the market. We haven't seen big tech reprise some of the highs that we saw from late last year. Even in the face of earnings that were pretty good, say from Microsoft, the stocks sold off. I mean, is this appropriate, or is there more to go?
Well, I'm a little bit downbeat, a little bit cautious about the AI spend. I think this year, everybody says there's sort of insatiable demand for AI. I'm not sure we're quite seeing that yet. I think there's a lot of open questions about that. And the Microsoft, Facebook, sort of those two companies reporting sort of demonstrated that. We saw Facebook have really good earnings and raise capex by a lot. Their stock is up. Microsoft raises capex by a smaller amount, but their numbers aren't quite as good. They're not seeing those returns from their AI investment, and their stock gets punished. I think investors are rightly starting to question how good the AI spend is for companies' earnings, and I think it's still an important open question. I think we're gonna hear a lot more of that as we move through the year.
Is that a fault of these companies and how they're spending the money, or is it fault of any single industrial build out in history where there needs to be some good money thrown after bad to build things in excess maybe of what they will be needed down the line in order to have the innovation that some of these technologies will create?
I think that's a fair assessment. Right? There is going to be some waste, some risk. It's by definition, risk means some of it won't pay off. What concerns me here is the extent to which we're adding debt on top of all this. We have a lot of companies adding debt to, we're not just investing out of free cash flow. Oracle, Facebook, others are taking on debt or debt equivalents. And that's always the point in the bubble when things get both really, really crazy, but also scary, right? I think we're going to see a lot of that sort of debt-fueled growth flow into numbers this year. And that's why we're bumping up against constraints. But when the downturn comes, and for me, semis are cyclical, there will be a downturn. At that point, the pain is amplified by that debt.
You asked this question in your note about which companies are going to potentially miss this quarter because of these constraints, because they didn't get the necessary components they need. Which companies do you think potentially could be those companies that missed this quarter because of those constraints?
It's a theme I'm hearing for all the companies I'm talking to, right? You started TSMC reported 2 weeks ago. They're having constraints. They're the monopoly, but they're having constraints. I think we're going to see that in a lot of the chip guys, a lot of the chip designers. They're not going to be able to get the capacity they want from TSMC, so that's going to be their constraint. I think that's going to be true for all of them. I think that's the big limiter on NVIDIA's growth this year is going to be how much capacity they can get out of TSMC's packaging facilities, right? And then you talk to the AI labs, and all they say is they want more and more compute, and they can't get the chips from NVIDIA because NVIDIA can't get the chips from TSMC in the quantities they want, and it just goes all the way up the chain.
Insatiable demand. Jay, appreciate your time. Jay Goldberg there of Seaport Global, some of the biggest companies on the planet, on a monster spending spree and determined to lever up and take the risk.
Because ultimately they're worried about being left behind if they don't take that risk, because others will eat their lunch. It's the reason why I'm actually really curious to see Amazon and Alphabet, especially because of cloud computing and what they deliver, based on the fact that people were disappointed with how much Microsoft was able to expand their Azure platforms. I also think about the likes of Apple and how much it's going to cost for them to actually increase the spend on their chips because of all of this spending. It's going to have to get more expensive at some point for the rest of us.
Amazing how quickly we moved on from a $300 billion market cap move on a single day in Microsoft stock.
Yeah, nobody seems to care anymore.
Like it was like nothing.
Well, gold took over. Gold was like, here, watch my beer.
It's been a crazy week, hasn't it? Coming up next, we'll catch up with Elena Schiller-Saver of the Conference Board, with consumer confidence sitting at the lowest level in more than a decade. Plus, Yahara has your morning movers. Pfizer falling, down by about 4 to 5%. The opening about 60 minutes away. The scores look like this. Equity futures on the S&P still positive for the session. We have been for the whole session so far. Up by 0.25% on the S&P 500. Up by 0.5 on the Nasdaq. With your morning movers, let's cross over to Yahara for more. Hey, Yahara.
Hi, John. We start with PayPal shares plunging even harder now, down 17% on a wave of news this morning. Let's start with the earnings because they appear to be the main catalyst. They were pretty rough. Not only did they miss on both the top and bottom lines, the growth outlook also did not look good. So they have chosen to make a change at the top, now choosing Enrique Lores, the CEO of HP, to lead the company, replacing Alex Chris. HP shares not taking that news well, down 2.8% in the pre-market. Meanwhile, Pfizer shares also falling down more than 4.5% now in the pre-market after it released early data from one of its new obesity treatments as the company tries to expand beyond its COVID lineup. Patients in the trial lost 12% of their body weight in 28 weeks. solid results, but Evercore analysts saying the results leave a bit more to be desired, citing the stiff competition from the likes of Novo and Eli Lilly, which are way out ahead. Pfizer also reporting earnings, and they did beat on both the top and bottom lines. And we end on AES, those shares continuing to gain momentum, up nearly 8% now in the pre-market on our scoop. That BlackRock Global Infrastructure Partners is teaming up with EQT on a potential takeover. This is a power company based in Arlington, Virginia, and they supply energy to the likes of Microsoft. That's it, John.
Yahara, thank you. Some of the movers in the pre-market from Yahara Anand there. A mover. Some movement from the Walt Disney Company. Let's get to it. A staff move at Ludlow, widely expected. It's official.
Yep. Josh D'Amaro, the parks chief, will be the next CEO of the Walt Disney Company. It's effective March 18th, 2026. That is when he will succeed Bob Iger. Bloomberg had reported that D'Amaro was the front runner back on the 1st of February. There's also a bit of shuffling with other executives here, John, that's worth discussing. Dana Walden is going to become president and chief creative officer of the Walt Disney Company. She was the co-lead of the entertainment business. And so it seems like she is given a broader portfolio while D'Amaro jumps from leading this parks business, which was undergoing a transformation, right? They were basically saying to D'Amaro in the interim, change the parks business, invest $60 billion, look at our investments elsewhere. But this, is expected insofar as that Bloomberg, had reported on it to be the case. And in about an hour's time, I'm going to speak to the chairman of Disney, James Gorman, and I think we'll learn a little bit more about why Josh D'Amaro was the right candidate versus those internally and externally.
Well, he's the man I want to talk about, Ed, and I'm looking forward to this conversation. And I don't want to be too personal about this, but just to state a fact. We're here because Bob Iger screwed up the succession planning and had to come back after selecting Bob Chapek. How important was it to get James Gorman involved in this process, a man who handled that process brilliantly at Morgan Stanley?
Yeah, so James Gorman took over the search in 2024, and it had been going on a little bit prior to that. It's a 3-year process. I remember being sat opposite Bob Chapek, the short-timed Disney CEO, back in May 2019 when they opened Star Wars Galaxy's Edge. And the idea was, when he was named CEO of Disney in February of 2020, he would take his experience of the parks and expanding IP, right? The Star Wars IP was absolutely critical. But by the end of 2020, he was no longer CEO, right? And it was well documented, some of the tensity and relationship between him and Bob Iger. I'm just going to say it for what it is. And, I guess we'll pose the question. Josh D'Amaro jumping from parks to lead the whole company is quite similar to the scenario of Mr. Chapek jumping from that unit to lead the company. And so, I'm very interested to hear why the internal candidates were best and what the options were externally as well.
And Ed, I do want to go back in time too. Why this company believed that the only man who could run this company was Bob Iger. How did this company get to that place?
Experienced operator. I mean, what's so interesting in the release that Disney have just put out, that they emphasized Josh D'Amaro is a 28-year veteran of this company and has held a multitude of roles. But with Mr. Iger's return, it was defaulting back to somebody that could handle the many tentacled beast, right? These different divisions, parks, cruises, entertainment, the restructure where they had the new business lines. It's difficult to run basically several different companies doing different things, particularly at a time, 2020, in the COVID era, where there was an intensity between the different streaming platform providers. That was really where they wanted to focus initially. Again, that's a great question to ask, right? Is that still the mainstay focus here, or is the parks business, the entertainment business, on parallel terms in terms of priority? Bob Iger understood how to run them all.
Ed, looking forward to the conversation in the next hour. Thank you, sir. Bloomberg's Ed Ludlow on the changes at the top of the Walt Disney Company. Leading those changes, James Gorman, the Walt Disney Company chairman, is going to be joining the program in the next hour.
It's somebody who, as you were talking about, has had deep experience in terms of handing over the reins of a very big corporation, and that would be Morgan Stanley. Look, we just are now seeing the 9th CEO for Disney in its 102-year history at a time of incredible transformation. The question of how they're going to deal with intellectual property, how they're going to deal with technology, how they're going to deal with the international relations at a time where more international visitors to Disney parks have come down. These are all some of the challenges that people are going to be looking for solutions from Josh tomorrow.
The problem with Bob Iger, of course, was he was sticking around as chairman, and it felt like he didn't really want to give up the reins. And you basically had two almost co-CEOs running the company, even though one was supposed to give up the reins and move to the side. James Gorman is taking a different approach. He's really coming from the outside. It's not Bob Iger going out and picking his successor. It's James Gorman. And maybe that gives him a kind of fresh slate coming into this.
Look, maybe I'm too hypercritical about this situation, but succession planning is a core part of any CEO's job. You're a custodian of the company. You are not the founder. And it's your job to find someone who can run the company. If the company's too complex for anyone else to run it, you've also failed. And I think these are conversations you have to have. As a Disney shareholder, for anyone who's watched this play out over the last 10 years or so, you can't be too happy with some of the returns you've seen.
This is the reason why James Gorman was put in there, right? I mean, how much has this literally been the reason for his being there and what he's been focused on up until this point?
Let's return to the labour market and get away from this. We're looking forward to the conversation anyway at 9:30 Eastern Time. Let's turn to the labour market. The impact of the shutdown beginning to build with Friday's payrolls already delayed. Mike McKee has more for us. Good morning, Mike.
Good morning, John. We also lost jolts today. Fortunately, you've got Elon Musk and AI and the Disney stories to fill in for the lack of economic data, which will only get worse on Friday because we don't get the jobs report either. Now, the question is, does this shutdown run longer and we lose some important data next week? Import prices, the ECI on Tuesday, and then Wednesday, the CPI. Those are in jeopardy because they are done by the Bureau of Labor Statistics, and it's labor that is not getting funded. We do have some good news for next week because private sector data and Commerce Department data do come out along with Census Bureau data. We get ADP and ISM services tomorrow, Michigan sentiment on Friday, and then we do get retail sales and existing homes next week. The question is, where do they fit in jolts and where do they fit in jobs? They could just move jobs to next Friday if this shutdown ends. We've got nothing of significance on Friday of next week.
Mike McKee, thank you. Hopefully we can sort this out. Hopefully we can get some data sometime soon. We've got some data from Yelena Shuletseva of the Conference Board. She writes this about consumer confidence. Confidence collapsed in January, hitting its lowest level since May 2014. Concerns worsened across all age groups, income levels and political affiliations. This wasn't a one-month fluke. Yelena joins us now for more. Yelena, good morning.
Good morning.
This one is really hard to internalise. Just the idea that consumer confidence is worse now than it was in the pandemic. Can you make sense of some of this for us?
And what makes it even worse is that it's a trend. It's just not 1 month thing, right? We have seen it declining for quite some time now. And that what makes it very legitimate, actually. So confidence right now is at the worst level since 10 years ago. But it was worse before. If you go back to the Great Recession, coming out of the Great Recession, that's how consumers felt at that time. So think about it this way. Now consumers are feeling actually that as bad as they were coming out of the Great Recession. So that tells you something.
So what does it tell you? Because a lot of people come on the show and they say ignore it, because frankly it has not been instructive to how the economy has done and frankly how you've seen companies and even workers demonstrate their spending capacities.
Well, every bird likes its own nest, and kind of like I do believe in the data, just again, because it's a trend. It's not just a 1 month thing. So I think there's something to it. Consumers are worried about jobs, consumers are worried about affordability, and consumers are worried about their income levels. So this is very important because that actually coincides with what the actual data are telling us. If everybody was talking about how great GDP numbers were in Q3, but I looked at income data in the same exact BA report, and that data is telling me that disposable personal income in real terms, which is income essentially adjusted for inflation and taxes, that has been flat since Q3 of this year. So that is weakening, and that is the fuel for consumers to spend going forward.
Is this an economic issue or is this a political issue?
In terms of consumer confidence?
Yeah, and I ask this because ultimately, if you look at the averages, they're pretty good.
Mm-hmm.
But if you look at the politics, it's the affordability crisis that you're talking about, and certainly a lot of people are feeling every single day. So does this get represented in the overall economic data, or in terms of what policies are going to come out of Washington, D.C. to respond to some of these issues?
I think it's both. It's really about how unaffordable things are, and it's all about the economy, stupid, right? At the end of the day, it's about prices, it's about jobs. Consumers are not feeling confident about finding a job. So it is about the economy. I do think that political things and other disruptions are playing a role as well. Consumers do hear the news, and oftentimes, confidence and sentiment indicators reflect what is happening in the news. And there's even some special indexes like news heard in the Michigan survey, right? So that is something to take into account.
Yelena, a lot of guests will come on and they're talking about the excitement of the tax rebate. Where do you see that money going?
I think, I'm very cautious about that because I think that people spend a lot of money during the holiday season and they may have to return this money.
It's spent already.
It's already spent. You do see a significant pickup in credit card balances over the last several months, and that is the data coming from the New York Fed. And I think that given, the, constraints in terms of income growth, in terms of the labor market, people will be cautious and will try to pay back some debt.
We've said it a few times on this show, energy bills in the Northeast are going to be insane over the next month.
Yeah, and it's not just because of the weather. It's also because of some of the other demands on it. I mean, yes, it's been really cold, and that's why I like to turn down the thermostat at the same time, to save money on bills. This is going to be an increase in political
Sound like Jimmy Carter.
area.
But yeah, the electricity prices are going up.
You know what Bramo does? When Bramo comes to work, turns the thermostat down and the boys sit at home and put on extra layers. You know about this?
Let's be honest. They're under
and they're
blankets.
watching right now, so now they
It's
know.
fine. No, they're at school. I mean, honestly, it's better for your health
You think?
to sleep in the cold.
They're watching. Turn the thermostat up, boys. Yelena, thank you.
Hey.
Yelena, thank you very much. Good to see you. Yelena Shuritz over there of the conference board. Let's give an update on stories worldwide with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Disney has named Josh D'Amaro as the entertainment giant's next CEO. D'Amaro will succeed longtime chief executive Bob Iger beginning March 18th, ending a 3-year search process. D'Amaro is a 28-year-old veteran at Disney and currently heads the company's parks division, which is by far its largest source of profit. PepsiCo is cutting prices by as much as 15% for its key brands, including Lay's and Doritos. The snack and beverage company is making the cuts this week ahead of Sunday's Super Bowl. Pepsi said it's keeping its package sizes the same and hopes more affordable products will help lift sales. President Donald Trump is calling on Republicans to nationalize voting in the United States ahead of this year's midterm elections. In a podcast interview with former FBI Director Dan Bongino, the president saying non-citizen voting is improperly influencing election outcomes. That is your Bloomberg brief. John.
Hey, Vonnie, thank you. Appreciate the update. Up next, Chris Harvey of CIBC anticipating a Walsh-led Fed to favour Main Street over Wall Street. That's up next. This is Bloomberg.
It is an environment where we are in a state of unprecedented flux and change, geopolitical makeovers, but the abiding concept when you look as an equity investor is that earnings are really going strong.
That was Julian Emmanuel of Evercore looking ahead to results from Alphabet tomorrow, Amazon the following day. Equities at the moment shaping up as follows going into the opening bell. Futures positive by 0.2% on the S&P. On the Nasdaq, up by close to 0.5. Turning to the economy, investors awaiting a new regime of the Federal Reserve under Kevin Walsh. Chris Harvey of CIBC writing, expect Walsh to lean QE hawkish, Fed funds dovish, and Main Street over Wall Street. Chris joins us now for more. Chris, good morning.
Good morning.
Let's breathe some life into that particular quote. What does that mean for equities?
So what that means is for equities is I think it's okay, right? I think let's just go piece by piece. On QE, Walsh is out there saying, hey, he's not a big fan. But really, what is he going to do? Is he going to shrink the balance sheet? No. But what he's going to do is probably he's going to change the duration around. He's been out there saying duration should probably come down, should match issuance, so on and so forth. In addition to that, he's been saying, or the belief is that MBS doesn't belong there. Maybe they do something with MBS, but nothing radical, right? If we go over to Fed funds, right? If you're going to favor Wall Street over Main Street, who funds at the front end of the curve? You have auto loans, you have HELOCs, you have small businesses, and so you will be much more aggressive, or probably be more aggressive at the front end of the curve, right? And we're going into midterm elections, right? He just got nominated. We believe he will be appointed, and the belief is we need to do something for the average person. And so that's not growing the balance sheet, that's not providing liquidity, that's really providing funding or relief at the front end of the curve.
Is that the kind of market that I want to be in cyclicals, in small caps?
Yeah, you do, but remember, this is probably not coming until June, maybe later. And so between now and then, that's a financial eternity. And one of the things that we've seen is small caps. We saw the January effect. I don't know if we really saw the rotation, because once earnings began, that January effect stopped. Small caps stopped outperforming. Risk stopped outperforming. And so I think what the market's saying is, yeah, there's some geopolitical risk, but maybe the fundamentals aren't strong enough. And the belief is if the Fed's not going to cut in the first half of the year, or not until the end of the first half of the year, we really have to think otherwise.
So what do you do in the meantime during this financial eternity where suddenly there's a question about whether Main Street gets some of the stimulus? And frankly, Wall Street is struggling with questions around artificial intelligence.
Right. So not to be too wonky, but one of the things we say, we want you to go up in quality. So higher quality companies, good balance sheets, good stewards of capital. In addition to that, we don't think it's the time to go bottom fishing, right? The chart can't look bad. The chart has to look good. Because a lot of these companies with positive price momentum, right, they do have better fundamentals. So we want to marry higher quality companies with companies that the market's already rewarding, be it no matter what sector you're looking at.
Is big tech still high quality at these valuations?
I think so. And I think one of the really interesting things is yesterday Oracle had a bond issuance. I think they had a convert issuance. That went quite well. Right, there's been a lot of concern about hyperscaler funding, and I think that put a lot of concerns and a lot of fears to rest.
Are you hopeful for the numbers we get from Alphabet and Amazon that this just continues?
I think the numbers in earnings season have been pretty good. The one thing I'm not seeing, and you still have a lot of idiosyncratic risk, right? But the one thing I'm not seeing is not seeing this acceleration, right? And if you need an acceleration in the economy, you need an acceleration in earnings to really go down to that secondary and tertiary bucket.
One thing we talked about is how much the tech trade has just changed.
Yeah.
Hardware versus software within Mag 7 as well. I'm not sure we can even talk about Mag 7 as a group of stocks. No. It just looks so different from Meta to Microsoft, and Apple has no place in that group.
I don't know if it has no place, but you're right. The phrase that I hate, and the phrase a lot of people use coming into this year, is it's a stock picker's market. Every year, it's always a stock picker's market. I don't understand that phrase, but I think it is applicable here. You do have, because idiosyncratic risk is getting bigger, you're later in the cycle, because the economy is not accelerating, because earnings are not accelerating, you really need a good idiosyncratic or stock-specific story.
Can I just pick up on that phrase, later in the cycle?
Yeah.
Late cycle or later in the cycle?
I think it's later in the cycle. So credit spreads, and you probably have seen this, hit a low we haven't seen since acid wash jeans were in favor, right, since 1997. The amount of issuance that we're seeing is really rather significant. These are the things you see later in the cycle. Right? Do I think the cycle will continue? I do think the cycle will continue, because I do think there's a lot of accommodation in the system, and I don't think the monetary policy accommodation is done.
So what kind of returns are you expecting this year? We've seen some projections for 7,800, 8,000, this idea that you can have AI continue to fuel this, even amid some of the wobbles that we've seen recently. Do you think that that's fair, or do you think that it's going to be more of a churn to year end?
I think so. Our expectation is for high single digits. It's 74.50, right? Last year we were much more aggressive, and what we think is by the end of the year you're going to start looking to 27, and now you're going to start looking at a situation where it's beginning to decelerate. That said, with so much accommodation on the table, and with the Trump administration pushing things in front of midterms, we could have a little bit of a melt up or a pop summertime, fall, I think.
So this is sort of the bipolar aspect of a lot of the conversations we have. Some people say because of the midterm elections, you're going to get a melt up. Other people say you could get a meltdown in certain names. I'm thinking in particular of artificial intelligence related energy types of projects, especially with the affordability crisis and how much you could crack down. There's been questions around the banks trade and what we've seen there. How do you pair these two ideas?
So what we're saying is, I think in the first half, right? You're going to have bouts of risk aversion. We've already seen a couple bouts of risk aversion, not excessive. That's going to continue. I think people are really coming into the year underappreciated the macro and some of the macro concerns. Underlying fundamentals are still good. We would buy any sort of 5% plus pullback. I think we do get some of that, right? Because expectations are so high. But at the end of the day, we think equities do go higher later in the year. And there is a possibility for a sharp pop higher sometime, maybe in the summertime, maybe in the fall.
What are you thinking of in terms of the summertime? A fiscal impulse from this administration? I just don't see what they can actually get through.
So it's a couple things. One, the deregulation, right? We've seen the change on multiples, but the E is going to start to fill in. And I think the economy, even though it's not accelerating, it's still pretty good. M&A activity, when you have credit spreads and the cost of funding this cheap, you're going to have a lot more M&A. We haven't even talked about IPOs and things of that nature. We see what's happening in the metal space. The momentum factor in the market is quite strong. And if it swings back to equities, it can really change prices very quickly.
We could see some massive IPOs in the next 12 months. The biggest IPOs we've ever seen. SpaceX could be one. That combination, $1.25 trillion. Just think about the fact that we just managed to build, Elon Musk and his team built this, but ultimately financial markets contributed to it. We just managed to build a $1.25 trillion company in private markets. That, 10, 15, 20 years ago, unthinkable, absolutely unthinkable.
What's even more unthinkable is it's not the only one. What kind of valuation is OpenAI going to have when they potentially IPO? And then will it be the justification for some of these private market valuations, or will it be maybe a bit of a rebuttal when they actually have to face the music and do an initial public offering? A lot of people wondering what the pricing will be like.
Chris, it's good to see you.
It's good to see you,
Thanks
too.
for being here. Thank you, sir. Lots to think about. Chris Harvey of CIBC. Coming up tomorrow, here's the lineup for you. Chris Ferrone of Strategas, Libby Cantrell of PIMCO, Gene Soroka of the Port of Los Angeles, Michelle Weaver of Morgan Stanley, and a whole lot more. Your equity market on the S&P 500 just about positive this morning, up by 0.2%. Succession planning in full force at the Walt Disney Company. Look out, James Gorman, the chairman of the Walt Disney Company, speaking to Ed Ludlow about 35 minutes from now. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.